Just a wonderful effort there, a plan to fix a fractured world. Lisa, we can what's great about there, and you may not know this, folks, Michael Spence is truly our link to the past of economics. He studied with the true giant John Hicks, I believe at Oxford, half a century plus ago. And Lisa, John Hicks, a contribution to the theory of the trade cycle, 1950. Nothing's changed is what I think you could hear from Professor Spence. And we see it this morning when you talk about permacrisis. Yes, I saw Teslas outside the National Portrait Gallery in London. EU, let's go after Elon Musk in China over importing Teslas from China. And that takes the permacrisis right down to the granular of this morning.
How are you proactive at a time where the parameters are so unclear? Where, yes, you do think about artificial intelligence changing a lot of how we do work and productivity, but then at the same time, could put a lot of people out of work, and you could have a permanently unemployed group of people. How do you have this discussion when people are worried on an existential level about their employment prospects, as we see in Michigan, in Hollywood? And that, I think, is the difficulty around having this conversation, but the necessity to have it in a real way.
But are they two separate conversations of the what if of AI out there somewhere versus the realities of diminished global trade and of the fragmentation that Georgieva at IMF talks about? I mean, the permacrisis to me is basically a return to the 30s. I mean, that's, pre-World War II. That's really the angst here.
Not sure what the analog is. It is definitely a moment that calls for some leadership and some ideas.
We will have to see, and we'll have continuing coverage of that, particularly on Bloomberg Technology, on Elon Musk, Tesla, in the EU. Futures negative 17, top of the hour, Mike Wilson of Morgan Stanley. This is Bloomberg Surveillance.
Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
There is a limit to how much good news for the economy can be bad news for stocks.
There's parts of the market that have been very overextended. The U.S. economy is holding up better than expected, whereas the Eurozone is kind of in stagnation.
I do believe we're going to have a lot of turbulence over the next year.
I think the economy is going to be slower next year and that the earnings estimates are too optimistic.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Trying to reconcile bonds and stocks and failing. Good morning. This is Bloomberg Surveillance for our audience worldwide, live on television and radio. Tom Keene, Jonathan Farrow, Lisa Abramowitz. We are very much focused on the bond moves that we have seen over the past couple of sessions and whether they cohere with a resilient stock market, Tom, and a resilient economy that people seem to be gaming out for the foreseeable future.
A lot of sweat out there. As I mentioned with the drawdown earlier, that's a favorite phrase of Mike Wilson's. The drawdown is we're not even correction status. What everybody calmed down, we pulled back. Wilson is not 100% in cash, go to cash. He's not in the triple leveraged, all cash fund. It's measured. It's September.
Well, okay, and that actually is a great point. Is this just a seasonal blip? And if it is just a seasonal blip, is there actually any coherence whatsoever in the moves that we're seeing in bond yields and the understanding of what that would actually do in equities that have really been resilient? I mean, yes, to your point, there hasn't been that much gloom, especially yesterday, the Magnificent Seven actually outperforming despite what we saw with yields reaching.
Yeah, I'm glad you mentioned that. We had a nice recovery in equities, and I'm going to take a lot of solace in foreign exchange. I'm looking at it as a barometer, a litmus paper of the global system, as we just heard from Brown, Alarian, and Spence. But what I would go to, it's September. It's a Saturday. Michigan comes out. They score 30 points. They win. I mean, it's September. That's what happens. Michigan, Nebraska this weekend, bloodbath.
I thought you were talking about the Michigan Consumer Confidence survey.
No, I'm not talking about. I'm talking about what matters in Ann Arbor.
Going forward. Well, let's get right to the data check because we've got an incredible guest coming up, and I really want to get his view on the coherence or incoherence of this equity market. Down, although paring back some of the losses, S&P futures down less than 0.4%. Euro actually climbing over the 106 line and just kind of hanging out there after going below it. But to me, really, it is the 10-year. And the fact that it's 4.5%, and yes, yields have actually come down from yesterday, but still we're talking 4.5%, Tom, after people thought this was implausible.
As I said earlier, as I said to Kathy Jones of Schwab, it's an incredibly elegant chart. It's got log convexity, higher yield. It's well behaved on a set of log moving averages I use. I'm sorry, trend higher yield.
And meanwhile, we are focused also on gas prices, just because we have seen that adding to the toxic brew of the past couple of weeks, which is oil prices higher, and people saying they could potentially go even higher.
There's so many different voices that we deal with. When we invented the program, we said, we've got to have a lot of different cross-sections of opinions. And so in meetings that we have, what do we meet? Like 3 hours a day arguing about this stuff. John and I just say, we need someone Bramo's comfortable with.
I am
so
comfortable.
Here's the 8 a.m. comfortable segment for
Thanks,
Bramo.
Tom. I appreciate that. Mike Wilson of Morgan Stanley. He's been making a lot of warnings recently. The latest saying that risks are building for U.S. consumer stocks, rating, quote, this price action is picking up on slowing consumer spend, student loan repayments resuming, rising delinquencies in certain household cohorts, higher gas prices, and weakening data in the housing sector, the quinfecta of threats, or however many you want to say that. Mike Wilson of Morgan Stanley joining us now. Mike, how much pushback? We talked about this before. Do you still get the same degree of pushback that you did a month ago, or are more people listening and saying, wait a second, in the anecdotal data, this is starting to make sense?
Yeah, look, I mean, I think the question for investors is always price. I mean, we're in a late cycle environment. Let me just set the table a little bit, right? So we're in a late cycle environment for the last year. And when you're in a late cycle environment, there's a lot of uncertainty, right? I mean, people erroneously called for a recession in the first half of this year. It didn't happen. And now they may be erroneously believing in like this beautiful soft landing with some reacceleration next year. They probably overpriced that in the summer. So what happens is investors get whipped around by price action. And I would say what's happened in the last 2 months is we are seeing a breakdown again in a lot of the stock market, okay? Yeah, the overall averages are down 4 or 5%, not a big deal. But some of these consumer stocks are really, really struggling. And I think that reflects kind of what we were talking about a minute ago before we get on air, which is that the middle, lower end consumer definitely is out of excess savings. That's starting to bleed a little bit into the higher end now as well. We have the student loan moratorium. And I just think that's the wild card. That is the risk for the fourth quarter is can the consumer continue to surprise on the upside?
Can you see some of these retail and consumer facing stocks, these small cap stocks, get blown out, have their valuations completely decimated, and the rest of the market chug along? And no one noticed because the Magnificent Seven keep heralding all of the cautious votes of confidence from a lot of the consumers that see them as cash cows in perpetuity.
Well, it can continue if you don't have that hard landing, okay? If you have a hard landing, then even the big winners will feel that, right? And I think that's what the market's betting on. The market's betting there is no recession. And we talked, the bond market, is that signaling, greater strength, or is that signaling that maybe the bond market's pushing back on the fiscal, kind of spending? I think it's a little bit of both. And if we don't have a hard landing, then the big names are probably going to continue to lead because they have scale and they have better balance sheets.
Let's go back to Graham Dodd and Coddle 101. Mike Wilson, how can you be as cautious as you've been and not have a massive cash position? What is your cash position? How invested are you within your caution?
Yeah, I mean, we're basically 95% invested. We're like 5% underweight equities. And we've talked about this before. We never go 100% cash.
Yeah, but the financial media does. It makes for great theater.
Of course. Now, what we can do, Tom, is we can be positioned more defensively within our equity exposure, which is what we've done, right? So we're skewed more towards kind of defensive growth, late cycle cyclicals, as opposed to we're not grabbing for beta, we're not grabbing for small caps, we're not grabbing for the stuff that's really kind of vulnerable if things go sideways.
Okay, you're with James Gorman. He's saying, Mike, I don't care about any of this blather. Just tell me about the damn banks. I've been remiss on this. Yeah. Keefe Bruyette Index, you and I know it, we love it. And the answer is it's a grim chart. You go back to pre-California, pre-idiocy out there with one, you know the game that they went through. It's one of the bearish charts I've seen in years. When do you know to load the boat on banks?
Well, look, it's the same story as the broader market, Tom. The bigger getting bigger. There's concentration, in the winners again. It's like the higher quality banks are performing
better. So are
you
long Apple?
Well, I mean, we are in many portfolios, obviously, because it's such a big part of the index. But Apple's another category of stock where people are paying up for the quality of the balance sheet, the lack of need for financing. But the banks are representative of the broader market, okay? The higher quality banks are outperforming the lower quality banks. That's just where we are for everything.
Lisa Shallot emails in. She says, ask Mike Wilson with his easy day job. She's got the real job managing money. Do you buy an R-squared tight to the S&P 500, or if I'm active managed, do I want to be idiosyncratic? Who did we talk to in London? Kathy.
That said who, what?
Kathy Wood Ark.
Oh, Kathy Wood.
Kathy Wood Ark. I mean, do I want to buy an R-squared tight to S&P 500, or do I want to get more idiosyncratic?
You want to be more idiosyncratic for sure this whole year, right? I mean, even though the S&P is outperformed, it's been 10 stocks. That's idiosyncratic. I mean, if you pick those 10 stocks, you did really, really well. If you pick the other 493, you didn't do very well. So the dispersion is really, really high. And it makes sense. Right now, the market's paying up for what I would call operational efficiency, cost leaders. It's paying up for good balance sheets. It's paying up for scale, okay? Will that change? Can we broaden out to the lower end of the market? If the market starts to believe that not only do we avoid a recession, but there's a reacceleration. That's what we need to see. That's what the market's trying to figure out. Hard landing, reacceleration. This purgatory land is we're just going to kind of slop back and forth, and the market's going to continue to gravitate to the lifeboats.
What does it mean to be defensive? And I keep asking this because some people say it's tech stocks. Some people say it's consumer staples. What do you say?
Well, I think it's both. I mean, obviously the market this year has voted with its feet saying they want to buy large cap growth stocks, not just tech, but growth stocks with good balance sheets that have scale. And I want to point something out that's really important for these 7 or 8 stocks this year. Now, X 1 or 2, most of the earnings recovery for these stocks has been a result of cost cutting. right? They got over their skis on too much spending last year. They reined that in, and so they've kind of manufactured an earnings recovery. If they don't see top-line reacceleration, this is where we're starting to see a separation now, even in those 7. And I think that's going to be another story for the fourth quarter and next year's. The market wants revenue growth, not just cost-cutting stories.
What we're talking about right now is the bottom line. We're not talking about the rates picture and what that does overall to some sort of macro call on equities. Bank of America strategist came out today and said, do rates matter for stocks? And if so, it's not priced. Do you agree?
Well, once again, for some stocks, it's mattered a ton, right? I mean, I just think, look, we said this at the beginning of the year, this is the most difficult part of the economic cycle. When you are late, we know we're late cycle for one reason, because we got full employment. So you can't argue we're mid-cycle or early cycle. That's silly. What you can argue is that the late cycle period can persist for a lot longer than people expected, and that's what's going on. Rates are the one wild card. The rates have really surprised everybody, bond investors and stock investors. Normally in a late cycle environment, rates come down. Why? Because the Fed's done. As you know, this cycle is unique. That's the tricky part of this cycle, because the Fed can't be proactive in cutting rates ahead of the recession. So we're just going to ride this until basically you run out of gas, and that could be another year. We don't know the answers to that yet.
I mean, I find it absolutely fascinating here. I want to touch on this through the next number of minutes. Mike Wilson of Morgan Stanley with us, folks. Dovetail your revenue line, your animal spirit in the equity market with Ellen Zentner's nominal GDP.
Yeah.
Bring it in real GDP. Who knows what disinflation is? Even Jim Caron doesn't have a clue. But the answer is model out nominal GDP and how it affects your revenue line.
So this is really interesting. This is where Ellen and I are kind of aligned. I mean, I think we're the only bank on the street where we called for a soft landing and an earnings recession. Both turned out to be true. So why is that? Well, because revenue growth and pricing has been actually not as good as the sort of pricing and the inflation numbers in the government statistics. Now, Ellen is, I would say, far from excited about economic growth. I mean, she's not calling for recession,
right.
But she's looking for basically 1% GDP growth, real GDP growth.
3.84% nominal.
Nominal, exactly. And so, 3 to 4% nominal GDP growth. I mean, could that lead to 3 to 5% revenue growth? Maybe. Here's the risk. The economy is not what companies see. What companies are seeing in pricing is very, very different than what the economic statistics will tell you. Very similar to 2021, when companies were getting 20% price, when CPI and core CPI were saying 6, 7, 8. So now if you have CPI 3, 4, you actually have companies seeing deflation, and the market's figured that out.
Let's come back on that. Mike Wilson with us here. This futures negative 15, S&P down 0.3%.
I'm curious, Mike Wilson of Morgan Stanley, as we parse through all of these sort of muddled signals, what's the one thing you think people are mostly getting wrong? Is there a conviction, a consensus that you think is inaccurate right now?
Pricing. So from a stock standpoint, this is where we're probably most out of consensus, and we were most out of consensus in 21 on the other side. This is the boom bust, which is that what you see in the amplitude of pricing is much greater in the real economy than it is in the government statistics. And I think that there's this sort of illusion that companies can continue to pass on these higher costs. That's what's happening under the surface. The market's figuring out that many companies don't have pricing power. The question is, does that usurp even the big guys? We don't know yet.
So would you ever consider buying bonds?
Well, we have been buying some bonds.
Really?
Oh, yeah.
Have you ever done that before?
Yeah, of course. I mean, we have a big portfolio of everything. So we think there's value. In fact, our rate strategists have been pounding the table on longer duration. We think ultimately that will be good value. It hasn't worked so far in the last two quarters.
Let's go back to our Ute. I mean, I'm going to run out of time here, but is Mike Wilson all convertible bonds and preferreds right now? I mean, it's like back to our grandparents.
No. I mean, look, you have to own equities in your portfolio for one very simple reason. A, we are in a higher inflationary environment. Okay, we think it's a volatile inflationary environment. That is your protection against this new regime. Right. So bonds are still part of your portfolio too. They're a safer asset.
Right.
But the question is, in the near term, is this going to pay off? Yeah.
Really interesting. Mike Wilson with us. He is with Morgan Stanley, and he is not 110% in cash. Futures negative 14. Dow futures at negative 102. The VIX quiescent off the Bramall rally we saw yesterday, 17.22 on the VIX. On Washington, Elaine Kammerich joins us, a former Clinton official here on the shutdown. Good morning from New York. Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
So the economy has continued to exceed expectations in its underlying resilience. So if the economy is fundamentally much stronger than we realized, on the margin, that would tell me rates probably have to go a little bit higher and then be held higher for longer to cool things off.
From Minneapolis, the aerospace talent, Neil Kashkari, Minneapolis Federal Reserve President. There, people go, why are the Feds all different? Minneapolis is the research combine like no one in America looking at infant education, like 0 out to 6 years old. They own the absolute high ground on that. Gary Stern over decades and decades. And this education scandal, Lisa, that we have in America of our youth versus so many other developed countries, it starts with Kashkari's Minneapolis.
The different regions all coming out with pretty different messages when it comes to where we are in the economic cycle as we parse through whether we're in for this higher for longer or whether we're in for something a little different than that.
What'd you take out of Mike Wilson? We had to slam into the break there, which we try to make. Farrell always gets the break perfectly. With me, they're like, they had the Bloody Marys out in the control room early this morning to say the least. What'd you take away from Mike Wilson?
That gloom is nuanced and that it's difficult to understand exactly where we are. He says we're late cycle, and yet this is an era where the Fed is not expected to be cutting. Something's got to give. And to me, it's either rates going down because of some sort of depressed growth or rates staying here and stocks muddling through. One or the other. It can't be both.
And what's fascinating to me, folks, and you heard it there early in the interview, and this goes to Gina Martin-Adams of Bloomberg Intelligence and many others, the disease is I make a joke about it with triple leveraged all cash in and out of the market and all that, and these adults are saying, no, you have to participate. And I think that's underplayed. And through all of his bear market call, Mike Wilson has participated.
Yeah, he's not exactly saying go all the cash. This is somebody who's being nuanced in how he allocates at a time of a lot of questions with respect to where we are in the cycle.
Right now, on presidents in history across the American fabric, Elaine Kummark joins us right now to say she's senior fellow at Brookings, former Clinton administration official, doesn't touch upon her wonderful books, which are really richly researched and written on the foibles of our presidents. Elaine, thank you so much for joining us. You are, I think of you and Michael Beschloss are the two I want to talk to this morning. What is the significance of a president on a picket line? Harry Truman wouldn't have done that.
Right. I think it's a big deal, and it's probably long overdue. The American labor movement has gotten weaker and weaker since the days of Harry Truman. In fact, it used to be that 33% of the American labor force was unionized. It's now down to 9%, of the industrial unions and a little bit more of the government unions. And at the same time, what we've had is this enormous ballooning in executive pay. There was going to be a come to Jesus moment with this. And I think now is the come to Jesus moment where the president of the United States is saying, if a company does so well that you are paying executives in the hundreds of millions of dollars, you got to do something for the workers.
Who has the voice of Coolidge, Hubert Heaver, and the rest of them? Who has the voice of business across America?
Oh, I think the president is very concerned about business across America. There's no doubt about it. And the old Republican Party, okay, the traditional Republican Party, used to be the party concerned with business across America. Now this Republican Party is off in la-la land and can't even get a budget, right? Can't even keep the government open. So you've sort of lost that balance we used to have between the party of workers and the party of owners. And now we're at a crisis point in both situations.
Elaine, how complicated is this issue at a time where the Democrats have been trying to transition away from fossil fuels and lean into electric vehicles at a time when a lot of the electric vehicle battery manufacturers do not have unions? And this is part of what spurred a lot of the discontent among the unions. How confused is the messaging right now?
Well, it's pretty confusing and it's pretty difficult, but it is the price of progress, right? I mean, we are going to move away from fossil fuels. We are moving to electric vehicles. You see more and more of them on the road. Here on the East Coast between Washington and Boston, where I travel a lot, there's a ton of EV charging stations at all the rest stops. So it's coming. And I think the unions need to cope with that and try to organize as much as they can. But the bottom line is we're out of whack here. I mean, we're seriously out of whack in terms of worker pay versus CEO pay. That's what's driving this. And that is why, by the way, the American public is on the side of the UAW and not on the side of business in this situation.
Is this enough of a headwind, or rather a tailwind for President Biden to get him over a hurdle that is increasingly big in terms of popularity, which is cost of living, which is his age, which is a question around some of these kind of confused messages coming out, supporting labor, but also having the energy policy that kind of goes against some of what he's talking about?
Well, it's good. That's a great question. And what you have to remember is presidential elections are not about the whole country. It's about certain states, winning certain states. This is going to be a big deal, a big effing deal, as the president himself says, in those states that are swing states. It's going to be important in Michigan, important in Wisconsin, important in a lot of those Midwest industrial states. And I think it's going to be huge in terms of his reelection.
For our Republican and Democrat listeners and viewers, Elaine Kamarck, does a president need a new vice president? There's such a tradition, second term, to recharge, reinvigorate, and figure out the politics of the next vice president. What's he do with the present vice president as he moves forward?
I think she stays exactly in place. And one of the things that's missing in all the discussion about Kamala is, guess what? She does really well among young voters, voters under the age of 45. And one of the things that is always forgotten in these discussions is that by the time of this election, people under 45 are going to be practically 50% of the electorate. Wow. By 2028, people who are today under 45 will be 54% of the electorate. Wow. There is a new generation taking place here, and they are a different generation than us baby boomers and the president's silent generation. And their politics are different. And guess what? They like Kamala Harris. They're happy that she's there. And that's why I don't think you're going to see any movement at all.
There is a debate between Gavin Newsom, governor of California, coming up with Ron DeSantis of Florida, a very unusual kind of debate at a time where Gavin Newsom is not running. Do you think that it would be a good thing if there were some other options at a time when a lot of voters are very concerned about Joe Biden's age and have said so in polls?
Well, they do say so in polls, but guess what? They don't vote that way. They said so in polls in 2022. They voted for Democrats. Every special election in 2023 has seen a growth in the Democratic vote. So I think, yes, people are concerned about Biden's age. You have to be. You have to be concerned about Trump's age, too. He's not a spring chicken. He looks like a walking heart attack, okay? You got to be concerned about age. But the fact of the matter is that is not related to votes. And they're two separate decisions that the electorate is making.
Elaine, thank you. So when's the next book out, Elaine, quickly?
The next book is probably out in November, and it's about disinformation in American politics.
Elaine, thank you so much. Elaine Kamark, whether you're Republican or Democrat, she speaks her mind, and every time she's on the show, folks, I learned something. I had no idea the preponderance of people under 45 years old in America.
It speaks to the anger that a lot of people have, that there isn't a representation that matches that at a time where the two frontrunners for the presidency are of a different generation.
It's great when she's on, whatever your affiliation. Very, very interesting. It's great when you do a data check where the tape's improved. It's 8:25 Wall Street time. We're up a solid 5. We were negative 23, Lisa. It was like edge of gloom there at 6 a.m.
Yeah, I mean, we're moving away a little bit, and you can see a little bit of a retrieval from yesterday's 10-year yields climbing above 4.5%.
How many Fed speakers do we have today?
Just one today.
Just one.
Thursday's a bonanza.
Julia Coronado will be your token Fed speaker today. Macro policy perspectives. Looking forward to that. Please stay with us. Again, futures at negative 18. This is Bloomberg Surveillance.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Bloomberg Surveillance on radio and television. Jonathan Farrow, Lisa Bramowitz, and Tom Keene. Jonathan Farrow in transit on the Gulf Stream. He'll be with us out of London off his very successful conversation with Gordon Brown, Mohammed El-Arian, and Michael Spence on permacrisis. It's a book making quite a splash this morning. Making a splash as well as Bramo. We've got a Bramo yield space, as they say, and to bring you up to speed on that 4.50% in the 10-year. I mean, stasis off of the theater yesterday.
But that's interesting in and of itself. Stasis off a theater that pushed yields beyond where people had previously expected, right? You would expect if it were just a blip on a thinly traded day that was a holiday for some in the United States and around the world, at a certain point, you would expect a big bounce back today with people flooding into buy, and you're not seeing that. And I think that in and of itself is notable.
Julia Coronado to be with us here in a moment on Fed Speak and all the rest of the parlor game. But first, Michael McKee with us, and as we talked to Mike Wilson about nominal GDP, Mike, you're looking at Anna Wang and what we've done at Bloomberg Economics, and they model out a 2024 of sub 4% nominal GDP. That about gets it done, doesn't it?
Yes, it would. And we've also got the new Bloomberg Economist survey of
excuse me,
Wall
the
Street
Economist. My fault.
Yeah, well, here's
surveillance correction.
Here's the interesting thing. For September, the economists are now seeing 2.1% growth for 2023. In December of last year, they saw 0.3%. So we have really marked up growth. It's come in a lot stronger than the Fed has anticipated. The survey suggests we're going to see 3% growth in the third quarter, which would be lower than the Atlanta Fed GDP is forecasting, but that's up from 1.8% in August. So some real changes to the way people are looking at growth. And it's also, if you look at the forwards, take a look at the five-year forward, it's been pulled up by these growth forecasts. And Wall Street now expecting more inflation, which is why you get people maybe musing about the Fed having to go much higher and throwing out silly things like 7%.
Well, and we can get into why you call that silly things when Jamie Dimon said it of JP Morgan. I'm curious, though, when you start gaming out higher growth, what you make of the drivers of that. What do they say is going to drive it at a time where people talk about the toxic brew of student loan repayments and higher gas prices and savings running out?
That's the interesting thing. The growth forecast is for 2024 unchanged, and we're looking at a big drop in the fourth quarter GDP of only 0.5%, according to the economists, because what we're seeing is a 3% forecast for consumer spending, up from 1.6%, but then consumer spending falls off to just 0.7% in the fourth quarter because of all those things that you're talking about. So the only thing you can say is that economists have been wrong for the last year, and they could be wrong again. And the Fed just has to keep an eye on it, which is why they keep that extra dot in there and why everybody at this point is talking in terms of could, should, would, possibly raise it one more time.
Have people moved beyond the lag effects of monetary policy? Are we basically looking at a situation where people are coalescing around the idea that we've already seen the effects of rates going higher and of quantitative tightening?
There's still a division on that because you don't buy a house every day, you don't buy a car every day, businesses don't invest every day. And so as rates have gone up, it has more of an effect going on. That's the argument of those who think we're still going to be subject to lags. Others say, well, the market's priced this stuff immediately, so you don't have to have the same kind of lags that you used to. It's one of those things that the Fed doesn't know for sure, and so just has to take as it comes.
The case Schiller out today, which is on housing. It's old data, 2-3 months behind and all that. We're all stunned by a 0% statistic, even a negative statistic on housing. How does your study of housing data fold over to rent disinflation in America?
Well, it's an interesting question. John Author's talking about it in his column today, for those of you who haven't read his column on the Bloomberg. But the way the government looks at it is they take rents over the course of a year, and they assume that a certain portion of that, they ask people what you would pay to rent the house that you own, and that's how they come up with the housing numbers. Others suggest that you should take the changes in rent month by month because rents are constantly changing and they have been going up and down over the past year, but that's not what the government does. Campbell Harvey down at the University of North Carolina has suggested if you did that, inflation would be 1.5%.
Right.
And so there's a significant difference in policy from that, which the Fed can debate at its next meeting if it has any data.
I knew you were going there, and we're going to continue the debate right now. This is important. Julia Coronado joins us with macro policy perspectives here. And Julia, I was setting Mike up for that question because I sort of knew what the answer would be. But if you play with the numbers, disinflation is really in trend. Why do we not believe that when I look at the bond market?
Yeah, it's, well, they're not necessarily inconsistent because one of the things, the key thing that has helped explain both cooling inflation and more resilient than expected growth is productivity, Tom. We are enjoying a productivity dividend as the pandemic frictions fade, both on the supply side, supply chains working better, and on the demand side, consumers have a normal demand pattern. They're more price sensitive than they were before. And what we're seeing in Q2 and the way Q3 is tracking is tremendous rebound in productivity. And companies have also been investing in transformation through technology that is labor saving. That should also pay dividends over time. We may end up with a better productivity trend this cycle than last cycle. That does mean that both we can have lower inflation and higher growth in bond yields. It's the secret sauce that explains all of this.
Okay, the secret sauce is there. I mean, Lisa, jump in here if you would. The secret sauce of this is the heart of the matter, which screams that we're data dependent.
Well, and that's the issue if we don't get the data, and we'll get there in a second, Julia. But just to build on what you're talking about, this idea of productivity filling the gaps at a time when we're learning to live with this new rate structure, do you believe in the long and variable lags, or have we already adjusted to rates at this level economically?
The way I think about lags, Lisa, is that there's two channels. There's the capital markets channel, and yes, the argument that through forward guidance, the lags there are a lot shorter than they used to be certainly resonates. We see the Fed engaging in lots of forward guidance and markets reacting instantaneously. But then we've got the credit channel, and that moves a lot slower. So something like commercial real estate has yet to really reprice and reset to a world of higher interest rates. The credit channel just takes longer. There's more fixed rate financing. And so the full impact of monetary policy, yes, still has long and variable lags. Of course, those are difficult to calibrate in real time, and that's exactly what leaves the Fed data dependent.
So we're looking right now at a situation where we could be entering a quiet period, sort of forced upon us because we're not going to get data if the government shuts down for the foreseeable future. How much can you lean into the risk of upside or inflation risk versus the downside risk that we were just hearing from Mike Wilson of a consumer that's getting increasingly strapped, that's run out of savings, and that it can't really afford some of the prices where they are?
Well, so first, we've got a tailwind from spot inflation. Inflation has been trending pretty rapidly lower, much faster than the Fed expected. Rates are much higher. Real rates have just taken another 75 basis point leg up in the last couple of months. The Fed doesn't need to do anything here. As long as inflation keeps coming in below where it's been, on its way towards the 2% target, the Fed should just say less is more and hold its fire. Inflation risk, the whole notion of reinvigorated inflation risk, comes from equating growth with inflation pressures. But if you have productivity, that breaks down.
First question, September 26th, Julia Coronado. Dr. Coronado, the jobs report that we see for September, do you have clarity with it, or is it a toss-up?
In terms of whether we'll get it or not?
No, I don't mean the shutdown. I mean, McKee's in charge of the surveillance shutdown central, but forget about that. Yeah. What are we going to see in that data?
Tom, in contrast to the GDP tracking, we really have seen some cooling in labor demand. We've seen it in job openings. We've seen it in hiring. Hiring has been slowing. It's been narrowing. So the sectors that are hiring have narrowed. We have seen no indication of broad-based layoffs. So the labor market is in this sort of stable moment where demand has cooled off considerably. It's narrowed to just a few sectors really driving job gains. So I would expect to see a pretty modest, moderate gain in jobs.
Julia Coronado, thank you so much. With macro policy perspectives, that's my first question in the jobs report.
What?
It's always September 26th of the month. This is a joy. Let me give you an anecdote of the romantic world of Bloomberg surveillance. I was sitting in our Washington office, and I noticed that there'd been some rain out or whatever of Capitals Penguins. So I turned to Michael McKee, and I said, Mike, if I can get tickets in this section, 42 rows up, and Sheila Johnson's Washington Capitals a rink, do you want to show up? And there was Michael McKee and I over Ovechkin's left shoulder on the power play watching the Magic. And that's what they did in Washington. They developed a set of teams that were just remarkable.
Yes, and now they've fallen off. They're not predicted to make the playoffs, unfortunately. The real issue for Washington this year is whether Ovechkin can score 40 goals again. He's about 70-some away from Gordie Howe's all-time record.
Or if Ovechkin can, you know, it's not going to be Ovechkin Crosby. We saw that game. On radio right now, you're seeing the images from the game that we saw. But Michael, the real question is, can Ovechkin go over to the Washington Commanders and sell out the season?
I'm not sure about that, but the Commanders have been playing better. You got to give them that, I suppose. Now, we should warn people that neither one of us is Commanders or Capitals fans.
No, but
we have our own teams.
It's a little vignette that we just, showed up one night at the Capitals for I think we were there for 30 minutes or something. But there was the magic of it. We'll talk about that in a minute with Sheila Johnson here, a force in Washington. Lisa, we've been remiss with all that's going on, and the shutdown's germane, but the jobs report, it beckons here in a short September.
Yeah, especially at a time where people are expecting that kind of resilience to continue, because you know what? I think jobless claims on Thursday actually has renewed importance after it keeps coming in lower than expected time and time and time again.
You're reading on this better than I am. I don't have the patience for it, but are we at a 75% probability on shutdown? Is that where we were?
Yeah, some people are saying that. Each person has their different expectations, almost a certainty.
Lisa and I are going to recap the markets here. It's important. Standard & Poor's 500 down 0.5%.
Right now, we're looking at markets that are doing all right. I mean, they're basically staying around this 4 to 0.5% decline. But I was looking actually at which stocks were driving it lower. And it is consumer discretionaries. It is some of the big tech stocks. It's kind of a motley picture of people trying to game out what we can understand from yields where they are.
We're away from October 13th, and James Dimon leading off the earnings season with J.P. Morgan, so maybe we're in an information gap there as well. Brent crude 92, make it $93 a barrel. The foreign exchange is really interesting, not the tension that we saw at 6 a.m. This morning, but on sterling 121.81, that speaks volumes about weakness on cable. But Lisa, it's still the bond market we've got to go back to, and the shock of a real yield of 2.15%.
I don't feel conviction this morning. I don't feel conviction anywhere, do you? I mean, is there any screaming buys? Is there anyone coming on and having a thesis that's not nuanced? No, everybody's kind of trying to readjust to where we are and kind of get a sense of what's noise and what's signal, and kind of treading water until there's something a little more definitive.
That's a data dependency that's away from there. We have not touched on it, but a yen 148.85, the degrees of freedom that authorities in Japan have is, I'm on the edge of nil. Like their morning is 7 p.m. our time. Should we be alert tonight? I wonder.
Intervention, you think so?
I'm not predicting it. I'm just looking at yen 148.86, the challenges of Japan. We barely touched on that. Coming up, this is an extraordinary story. Sheila Johnson will join us. You, of course, know her from BET, the Johnson family, and all they've done in media and sports. It's a much more interesting story. This is Bloomberg Surveillance from New York. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I think it's going to be hard to get inflation back to the target, and that probably means if inflation is sticky, we will see additional interest rate increases, and ultimately that probably does lead to a little bit more of a slowdown in the economy. Whether that's a recession or it's just a slowdown, it's hard to say, but it would be unprecedented to go through this type of a tightening cycle and not see us get to a little bit of slower economic growth than what we're seeing right now.
The economist, David Sullivan of Goldman Sachs, why don't they just say, like Moynihan come out and say, well, I was talking, well, Ethan Harris is retired now, but, I was talking with, whoever, Gapin over at Bank of America, or for Solomon to say, I was talking with our Dr. Hatzius, and what I find most interesting in his research is,
right.
And then I'd really sit forward.
Well, at this point, they have to kind of prognosticate and give their larger vision, and they are. And we're hearing about higher for longer pretty much across the board.
Let's revisit. We went light on this today. Farrell probably would have beat it to death, but there's the idea of James Dimon coming out with a 7% statistic on a Fed rate. Is that borderline irresponsible, Lisa?
Well,
Abramowitz?
I think that it kind of speaks to where we are at this moment. And a big question as we speak to this moment is, what is the ramification for consumers at a time where costs are going up? And I want just to quickly take a look at some of the consumer discretionary stocks, the top consumer discretionary stocks, and they're underperforming the market. Kind of to the Mike Wilson vein of the world, when you look at the declines in Expedia, in Hilton, at the idea that you could have travel crimped by the idea that people are losing buying power. Expedia shares down 1.2%.
Losing buying power.
Yeah.
I went both ways on United. I could not find a place to sit. It was like a happy hour at the University of Illinois, years ago. I mean, I couldn't find a place to sit in the clubs coming and going from London because you had the Gulfstream.
Okay, I didn't have the Gulfstream, but I will say that there is still a lot of travel. So this is the big question. When does it really get used up?
When does it get used up? I'm seeing prices come down, which means people travel more. The only problem is hotels.
Yeah, well, and they're expensive.
Okay, right now, and this is a joy in this time of America, when we talk about all these different themes of diversity and the woke wars, the culture wars, and that, there is a breath of clarity coming out. Sheila Johnson, BET co-founder, she's author of Walk Through Fire, a memoir of picking herself up from her childhood, getting it done, getting totally slammed by a divorce, and keeping it going. She's, of course, done better than good over the years in Washington. As Mike McKee and I were talking about, a modest acquaintance with the ice hockey Capitals, with women's basketball, and the source. And she has written an exceptionally terse must-read. And I love how you end it. Nice granola guys out in Utah, and you show up to pick up Robert Redford in a Humvee?
Absolutely, yeah.
And he gave you a lecture.
Oh, I got to know him because I was on the board of Sundance.
Yeah.
And I've admired everything that he's done for the film industry. And we just got to know each other, and he came all the way to Middleburg, Virginia as I was getting ready to start construction, looked down on the town, and he says, you got to put a film festival here. We are now into our 11th year.
of doing that. And
Yes.
I like that you showed up at a Humvee, which speaks volumes about Sheila Johnson. I want to go back to the emotion of the beginning of the book, which people, you know, you didn't come out of some fancy prep school and got it going with the first $1 million or $2 million.
No.
Take us before the first $1 million. What was the catalyst to pick the pieces up from your childhood?
Well, first of all, it was a learning area where I, for the first time in my life, had to grow up very fast at the age of 16. My father suddenly left. We were a middle-class family, first African-American, not the first, but one of 8 African-American neurosurgeons in the country. And so we had some sort of status in society. And for him to suddenly leave, it just left my mother broke. Women did not have the wherewithal to have our own bank accounts or anything. So that is stuck with me forever. And that has been the impetus in which I have decided to leave my life and take charge of it.
What people want to know from you, I'm going to slam it forward to the present. Lisa's got a bunch of insight as well. What do you think of the expression of our culture war now is witnessed by a corporate effort of diversity which seems to stumble on itself, witness Hollywood and mistakes made, or just the general debate over this word woke? You're about as anti-woke as I've ever seen. How do you synthesize that?
Well, I don't quite understand woke. I just know hard work is at the bottom of everything I do. My value systems are there, and it's really, really important that I continue to push on and not really, you know, focus so much on race, but I am very aware of it and the pitfalls. But I just try to fight through it, and I deal with the people that want to challenge me on it.
What do you make of some of the recent striking activity, particularly with Hollywood, given your intimacy with that, at a time where people are trying to take charge of their life and don't know what the future landscape will look like with artificial intelligence and streaming and don't have those guarantees? Do you think that there are legitimate issues that are not being dealt with responsibly and in the public eye from some of these companies?
Yeah, I think what's happening is all media is transitioning so fast, and even in the film industry. And I know people in the film industry, they're seriously concerned about what their future is going to look like. I mean, I deal with the film festival. I have a LA Film Advisory Board, and they're talking to me all the time about, are we going to get films this year? Are there still films being shot? Are they in the can? But I think this is something that we've got to watch and we've got to be careful about because the landscape is changing quickly.
You got these great vignettes. I want to take a vignette and take it to business as well. You're sitting there one day, you're over your Sanka coffee, you know, you're hanging out, you've probably been, you know, you're going, Ben's Chili Bowl, U Street lunch, I think we can do that.
Yeah.
And Whitney Houston wanders in. What's it like when Whitney Houston comes in the door?
Well, first of all, she's one of the most beautiful women I'd ever seen. She's very thin, very talented, but I also could just sense a little bit troubled. But I admired her. She's a great talent. And
I got to drag it forward now. Sheila Johnson, another cup of coffee, except it's a fancy cup at the Sunset Tower Hotel. It's you and Mr. Iger. What's your advice to the modern train wreck known as Disney?
Oh, my goodness. That's something I really can't answer, but I will tell you, Disney has always been a force. It's a force in media, in entertainment, and I'm just terrified about what's going on in Florida right now. I really am.
Well, if you push it forward from your BET experience, would you be able to found that company today, in today's world?
You know, this question has been asked of me many times. I'm really concerned about where BET is now. I think we need to look at it. I have not been happy with it for years and years and years. There's not enough balanced programming. And I just think that the landscape and the racial landscape of what African Americans are watching is changing. And I just think that we have got such a broad perspective of people out there that want something different, especially this younger generation. So we need to reevaluate what are the goals of black media and what are the answers? What is it out there that we need to answer?
The heart and soul of your voice, we got to wrap it up here, Sheila, in celebration of Walk Through Fire, but the heart and soul of your work is to find a middle ground. And in these culture wars, you know, I was weaned on Edmund Burke senator from Massachusetts. This is a long time ago. How do we get a fractured America back to a middle ground?
Well, I think what we're doing through the Salamander, through my company, is we're bringing in programming. I've kind of taken it from BET and into the hospitality business with the film festival. Also, I've been able to check the box on the diversity issues where I bring in 41 of the top Black chefs from all over the country to really celebrate food from the African diaspora.
Right.
We talk about these issues in panel discussions. I'm doing it in a fun way, bringing the American back.
Deeply personal and courageous book as well. Lisa, that really goes to the heart of the battle of voices like Sheila Johnson versus some of the woke stuff we get slammed over the head with every single day.
It's an important conversation to be having when we talk about all of the dissidents on the social level, to just be having an honest conversation.
What are we going to do at 9 o'clock? We got housing data?
We have housing data,
You know,
yeah.
what we're
The
gonna move
S&P,
forward on.
Case Shiller, CoreLogic, Tom Keene.
Case
housing
Schiller,
data.
always and forever. Good morning.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lines.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy. From New York City, for our viewers worldwide, I'm Matt Miller, in for Jonathan Farrow. We see futures down across the board in a reversal of the gains we had at the close yesterday. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
President Biden heads to the UAW to join the picket line. And the shutdown showdown continues as the House returns in Washington, D.C. Plus, Jamie Dimon fires a warning shot over higher rates that we hadn't even really thought of. Let's start with the big issue, and that is rate expectations.
We have high for longer rates. Rates are higher for longer.
To digest higher rates for longer will take time.
Markets are going to have to accept that they really are willing to keep interest rates higher for longer.
Our concern is that they are going to keep rates too high for too long.
We're skeptical they can actually keep rates that high for that long.
They're going to have a very hard time justifying keeping rates as high as they've been.
Rates are somewhat too high over the long run.
I don't think rates need to go any further than where they are today.
The economy is slowing. Inflation is decelerating.
Inflation is already coming down and headed in the right direction.
Core inflation is going to fall a little faster than the Fed expects.
I don't see us going to 7%.
Even if rates were to go to 7%, it's not an immediate reset across the board for the consumer.
The impact of 5% Fed rates is coming.
They're going to just wait until something breaks either in the economy or markets or both.
Joining us now, State Street's Lori Heinel and Eric Knudsen of Neuberger Berman. Now, nobody there mentioned 7%. In fact, I haven't heard anybody mention 7%. It wasn't even in, the realm of thought until JP Morgan CEO Jamie Dimon warned the world that we're not prepared for that. No kidding, in the times of India. Lori, what do you think about Jamie Dimon bringing up 7% seemingly out of the blue?
Well, it is out of the blue, and certainly that's not anywhere in our trajectory at all. But what we find when you have these kinds of dialogues is that the sentiment always swings to the extreme. So I think it was more provocation than really think that we're going to see rates at that level.
Is he maybe opening up a path for the Fed to go even higher?
I certainly don't think the Fed is going to weigh on what Jamie Dimon says, with all due respect to Jamie Dimon. I think it's going to be more about what is the inflation trajectory and how is the resiliency of the underlying U.S. economy evolving. Our view is that they've actually done enough already. Obviously, rate hikes follow through with a lag, and we see 2024 as being quite a precarious position. So we don't think that 7% is anywhere in the Fed's mindset at this juncture.
Eric, what do you think about, higher rates for longer? That's much higher, 7%. Most people, I think, expect that we stay here or maybe go 25 basis points more in November.
Yeah, we agree in general with the higher for longer view, not 7%. But we also think the Fed is likely done at this point. So it's more about what happens along the curve. And our view is that what we're really talking about here is a shift from volatility in the bond market from the short end of the curve towards the long end of the curve as investors struggle with the, how our deficit's going to be financed going forward. And so where we see the opportunity is more in the shorter end of the yield curve, say 2 to 7 years, and then the potential for continued steepening as the volatility shifts to the long end.
We have seen people going longer duration. That's been a bad trade. Do you think that needs to be reversed?
That's what we would say. We've taken some duration off. We think that while the Fed is probably at the 10-year Treasury is probably at the high end of the range, you do have this risk of longer yields continuing to have pressure on them based on supply and demand and some of these long-term challenges around term premium. The notion that not only are we going to be higher for longer, but real yields are going to be higher. So we want to be, more in that intermediate and in portion of the curve where there's a lot of opportunity, and we paid plenty without taking on that additional duration risk.
All right, investors are going to be digesting a busy day of Fed speak that we had yesterday, with more to come throughout the rest of the week. Bloomberg's Michael McKee joins us now for more. And Mike, I wonder if anyone's going to respond to Jamie Dimon's fascinating float of a 7% possibility.
I doubt it very much, but we'll look at that in just a second. I want to first show you why people are concerned. This doesn't justify 7%, but it does show you what the issues are on Wall Street and for the Fed. The white line is the new Bloomberg Economic Survey Out today, economists across Wall Street and the U.S., what they think is happening with growth. The number doesn't matter so much as you can see the trend. It's getting stronger. And then we have the 5-year forward. Here's what the markets are thinking is going to happen with interest rates. As growth goes up, interest rates have to go up as well. So that sets the stage for what's going on. We have had Fed officials talking, and while they're not committing yet, except for one, Michelle Bowman, they're basically saying there's a good chance we could see rates go higher. Neil Kashkari last night, rates probably have to go a little bit higher. Bowman says they will likely be needed, and Susan Collins said it's not off the table. There is still a group that, well, I guess what you would call doves, what passes for doves these days. Austin Goolsbee yesterday says we may be on the golden path, but there are a lot of risks, and the path is long and winding. And then Mary Daly said earlier that we'll be watching. We'll see what happens with rates.
That's good to know.
Let's talk about what, well, sort of what Jamie Dimon said and sort of what's going on here. People are concerned that rates have gotten very high, and to that I just say, oh, you kids these days. You go back and you look at real rates, and hat tip to Nick Colas from DataTrek for this. You look at real rates over history. This is the 10-year, and basically they track the inflation rate at about 2%. And so if you're going to have a 2% real rate, you're probably going to have a 4 to 4.25% nominal rate. And that's what happened through about 30 years until we got to the great financial crisis and the Fed pushed rates down. So we may be just normalizing rather than seeing something unusual in the markets.
All right, fascinating stuff. What's your take, Mike, on Jamie Dimon warning that 7% is way too much for this economy?
Well, I don't know the question he was asked, but basically 7% would probably be too much for the economy, which is why the Fed wouldn't do it. If it put us into recession, which it likely would, they'd be cutting rates, and they also would know that it would be an issue, so they probably wouldn't even go there. Markets might price something like that, and then we would see an economic reaction to it. So I don't think 7% is realistic at this point. You'd need an awfully large increase in inflation.
Yeah, I just thought it was pretty amazing to see that story in the Times of India. Michael McKee, thanks very much for that. Let's get back to Lori Heinel and Eric Knudsen. And Lori, what do you think about the possibility of a soft landing, or maybe does 5.5% even push us into a recession? Because we're already looking at a consumer that's spent all of his savings, is putting more purchases on credit cards. Delinquencies there are ticking up. Delinquencies on auto loans are ticking up. We've got a UAW strike that threatens to go on longer. We're very likely to see a government shutdown. I mean, the headwinds are there, right?
They definitely are, but the U.S. economy has proven surprisingly resilient. Certainly the consumer still has more capacity to spend, and as long as labor markets remain strong, which we see nothing in the immediate future that compromises that, we think that we're going to sort of mutter along. We don't have any recessionary impulses forecast for 2024, although interestingly enough, the longer that the Fed stays higher, the more likely you do see some sort of contraction in late 24. So 2024, early part of the year, probably still more of the same, 1% growth, that sort of thing here in the U.S. But we continue to push back that danger zone, and now the back end of 2024 looks quite precarious.
Eric, what's your expectation for the U.S. economy?
We agree with Lori that the short-term, setup is still reasonable, muddle along, or even, a fair amount of short-term strength, whether it's the consumer unemployment, still fiscal, significant fiscal spending. But as you get into 24, we don't think we're out of the woods yet. Consensus growth forecasts show declining expectations of growth in 24. PMIs are not, constructive and other short-term leading indicators. And so we see a potential conflict. Certainly there's recession risk, but even if it's just slowing growth, both real and nominal, a conflict between the top-down forecast and what's currently priced into equity markets, where GDP or EPS growth for the S&P is expected up 10 to 12% next year, we think there are some potential challenges with realizing that kind of growth given in earnings, given the overall economic setup.
I mean, the oil price is one thing that I find fascinating, and Farrow and Abramowitz both have been talking about whether this is, a demand-driven rise in price that we've seen, or is it simply because of supply cuts? Will that push us into a recession? What's your take on $90 oil, Eric, WTI, 93 on Brent?
Yeah, it's a contributor to part of why the setup for 24 is challenging. We think inflation is going to, while it has been declining and could decline further, is going to be sticky, and not just the last mile to target inflation, but the last number of miles to target inflation is going to be challenging for policymakers. That's going to lead central banks to stay higher for longer, even if they don't have to raise policy rates, but not cut them as soon as perhaps investors are forecasting. You combine that with, as you highlighted, challenges from the wage side, changing relative power of labor versus capital, deglobalization, and increased friction in the global environment. We think that inflation is not just going to be higher in the short term, but is potentially structurally higher. So that is another challenge on that 2024 expected earnings per share on the margin side, and a reason for us to be on that 12 to 24 month horizon more cautious, more defensive, want to be more oriented toward defensive holdings in client portfolios.
Lori, what do you think? I mean, do you get more defensive here? We've seen the S&P 500 come down below 4,400. The NASDAQ, I think, off 8% from its July highs. Small caps are down 11, 12% from the July highs. Do bonds look a lot more attractive to you right here?
So we've been sort of barbelled here. First of all, in our bond portfolio, we've still held relatively high levels of cash, nearly 10% in cash, because we think clipping that coupon at 5% or better without any risk is actually pretty attractive in here. And we've also maintained a little bit of long duration, in part because we don't want to try to call the bottom here, but we do think that yield levels on 10 years and 30 years right now are pretty attractive on a relative basis. But we also think that the U.S. is pretty resilient, and with the back off that we've seen over the past couple of weeks, we think that U.S. equities, while they're not, sort of super cheap, certainly the entry point right now is pretty good, and given the underlying strength in the economy and seasonality, we're still a buyer of U.S. equities here.
All right, Lori, you're going to stick with us. Eric, you're going to stick with us. I want to get right now, though, over for a look at stocks ahead of the opening bell to Abigail Doolittle. Abby, what have you got?
Well, Matt, we do certainly have U.S. futures under pressure, and while big tech is a big piece of it, we have a number of idiosyncratic stories that are also weighing. First of all, Alibaba shares of that ADR down about 1%. This after they announced that their logistics arm is going to, or has filed for a $1 billion plus Hong Kong IPO, the first of several spin-outs. Investors right now seem to be not liking that, or it could be the overall tone in that part of the world. Sirius XM Radio down 9.23%. This is Liberty Media is planning to split off Sirius into another unit with the rest of Sirius XM Holdings. They already own about 83%. Investors seem worried there. Messy situation. And then finally, United Natural Foods plunging down 20.2%. They issued a profit outlook. The quarter that they reported was okay, but the profit outlook, it missed the average analyst estimate. And they also did add 3 new members to its board as part of the ongoing customer and supplier focused transformation plan. Look for other food suppliers to be under pressure as well, Matt.
For a long time, we called that a profit warning, Abby.
Yes.
The term was banned, I remember distinctly, about 20 years ago, but I think we could bring it back. Profit warning at United Natural Foods. Abigail Doolittle, thanks very much for that. Coming up, Biden heads to the UAW picket line.
I think the UAW gave up an incredible amount back when the automobile industry was going under. They give everything from the pensions on, and they saved the automobile industry. Well, I always support the UAW.
That conversation next. This is Bloomberg.
do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
I think the UAW gave up an incredible amount back when the automobile industry was going under. They give everything from the pensions on, and they saved the automobile industry. And I think that now that the industry is roaring back, they should participate in the benefit of that. And if you take a look at the significant increase in salaries for the executives and growth in the industry, they should benefit from it. So yes, I always support the UAW.
President Biden is going to head to Michigan and try and bolster his pro-union credentials, joining UAW workers on the picket line, potentially, as their strike against Detroit's Big Three continues. Union President Shawn Fain reportedly set to join the president as negotiations continue, but the UAW continues to withhold an endorsement for Biden as he runs for re-election. Let's get to our team coverage. Bloomberg's Anne-Marie Hordern joins us, as well as Kaylee Lines, both out of Washington, D.C. So, Anne-Marie, what do we know about this trip, and will he actually stand on the picket line holding a sign?
It does look like POTUS is headed to the picket line. That is what the White House is trying to signal and triumph with this move. They're saying it's unprecedented for a president to join a strike. So that says to me, he'll be out there shaking the hands and meeting UAW workers who are on a picket line. I think that's the closest thing you're ever going to see to a president of the United States joining a picket line. Not sure if he'll actually pick up a sign or not, but that's what he's going to be doing. Unlike the former president, who I believe will just be giving a rally tomorrow, really in some counter-programming to the Republican debate, the Republican presidential debate that'll be airing on Fox News. For this administration, even though the president is walking a very tight rope right now, continuously asked yesterday at the press conference, Karine Jean-Pierre said that they are not trying to weigh in on negotiations, but the president wants to stand in solidarity with workers. He'll be taking that chance today when he heads to Detroit.
Kaylee, aren't those workers going to have some questions for President Biden about his EV push? I mean, part of this is about the concessions they made post-financial crisis, but a lot of it is about that EV push coming from the White House that they're concerned threatens their jobs.
Yeah, this is one of the fundamental difficulties for the Biden administration, because while he is trying to be the most pro-union president in history, as he has self-described himself, he also has this big push toward electric vehicles. And as the future job security of a lot of these workers, and frankly, what their wages will look like in a more EV-centric world, that is one of the fundamental issues in these talks. This isn't just talks about wages, although the union remains far apart from all three automakers on that subject, but also the issue of job security, in addition to pensions and everything else that we have seen in the past, Matt, as you allude to. Now, as for progress on those conversations, we know that Ford, of course, was spared the escalation last week because of progress in those talks with that specific automaker. The union said yesterday that those talks are very active, though there is still work to be done on a contract. What is interesting, though, and this ties back to EVs, is Ford's decision yesterday to pause construction on a $3.5 billion battery plant in Michigan. That was due to scrutiny on the part of Republican lawmakers because of ties to a Chinese company. The union has blasted that decision. Sean Fain called it shameful. So that could be something that is maybe coloring these talks as they move forward, Matt.
Yeah, absolutely fascinating developments with that battery factor, because that is actually quite old news, that partnership. In terms of former President Trump, Anne-Marie, he's going to go there, as you pointed out, and it's kind of counter-programming to the Republican debate that he's going to skip. But he's also looking for support from a union whose president has said pretty unequivocally, you're exactly the kind of person that we're against here.
Well, that's exactly what Sean Fain said. He said it's billionaires like the former President Donald Trump that they're actually standing up against. The issue, of course, is that Trump knows that he's made indents and inroads with rank and file of labor unions. Even if top brass decide that they're going to endorse a Democrat, we should note UAW has yet to endorse a candidate. It's not going to be the former President Donald Trump that they would endorse. But rank and file we have seen flip in the past, according to pollsters, from Democrat to Republican, and Trump's trying to get them back. Remember, he flipped Michigan in 2016.
All right, Anne-Marie Horton and Kayleigh Lyons coming to us from Washington, D.C. Thanks very much for that. Let's get back to Lori Heinel and Eric Knudsen. And Eric, let me ask you how much of a threat this strike is to the Fed's job of bringing inflation back to 2%. Is it concerning?
It's one of the elements. It's as I mentioned earlier, we're in the midst of seeing a change between the relative power in labor and capital. These are long-term relationships. We had a long period through globalization where capital and corporate profits got more of that share of economic outcomes. We're seeing that begin to shift. That's partly associated with policy. It's partly associated with demographics relative, the fewer workers and tighter workforces. That should lead to higher wage pressures, and that'll play out both in manufacturing costs, but also in the service economy, which is more driven by wages and a larger portion of the U.S. economy.
Lori, what's your take on, the strike going long? It's a problem, right? Does the government shutdown matter?
Well, all of these matter through a couple of lenses. First and foremost is what is the trajectory of inflation? And nobody wants to revisit a 1970s style wage price inflation spiral. So to the degree that there are significant gains made by the unions, that raises the specter that translates into inflationary impulses in wages in other domains. The other piece is just uncertainty. Investors don't like uncertainty. So while you're seeing a lot of sell-off in markets be related to rising interest rates, there's also this concern that there are other things that just cloud the outlook. The data is very unreliable right now because it's skewed by a lot of these idiosyncratic factors.
Yeah, well, and as Mike McKee points out, if this government shutdown happens and goes on, we could get much less data. Lori Heinel there from State Street and Eric Knudsen from Neuberger Berman, thank you very much for joining us. Coming up, the morning calls, and then later, Aaron Kennan of Clear Harbor joins us around the opening bell with his take on the higher for longer narrative. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, We're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
City. From London, in Sydney. From Washington. In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
5 minutes ago until the opening bell, and we're seeing futures down across the board on this Tuesday morning. Let's get to your morning calls. First up, Piper Sandler initiating coverage of Foot Locker with a neutral rating and a $19 price target, waiting for signs of execution amid a challenging macro environment and a lot of shrink. Next up, Oppenheimer naming Domino's Pizza a top pick, raising its price target to $450, seeing the company as an underappreciated revival story into 2024. And finally, Stifel lowering target to $130, maintaining its hold rating, pointing to likely decelerating consumer spending in mid-September. Coming up, we're going to get back to the Fed's path forward with Aaron Kennan of Clear Harbor. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
back to the open. We're looking at futures that are down across the board on the equity indexes right now. Just about to hear the closing bell, and it could be a reversal of the kind of risk-on close that we saw yesterday at 4 o'clock. There, you hear the opening bell on the New York Stock Exchange and the NASDAQ. Let's flip up the boards and take a look at some of the other asset classes that Farrell likes here. 105.94, dollar strength pushing the euro down. The 10-year yield reversing course today, but still over 450 at a well, more than a decade high. 2007 was the last time we saw 450, 451, 452. And NYMEX crude under $90, but just at $89.40 is off 28 cents right now, and we see Brent holding under 93. One of the stocks to watch at the open will be Tesla, the EV maker, under pressure after our reporting that the company is caught in the crosshairs of an EU anti-subsidy probe into Chinese EVs. Bloomberg's Abigail Doolittle has more on that story. Abby?
Yeah, Matt, it turns out that it's not just NIO that's coming and other China manufacturers of EV that's coming into the spotlight. If you recall, just last week we were talking about this EU investigation into subsidies for China EVs. The EU conceivably trying to protect some of their own automakers that are pushing and producing EVs that are generally perhaps a little bit more expensive than some of the ones coming out of China. But it turns out no one ships more EVs produced in China to Europe than Tesla. And an early investigation suggests that Tesla has, in fact, benefited from those subsidies. The aim of the EU investigation will be to determine whether and the degree to which China has subsidized Tesla and some of those domestic manufacturers. Now, Tesla started producing or exporting, Model 3 sedans built at its Shanghai factory in late 2020. As of this year so far, they've exported nearly 94,000 made-in-China vehicles to Europe. The next largest amount is, and that's 47% of the deliveries from China. The next largest is closer to 58,000. China to Europe, then, for Tesla, Matt, represents about 5% of Elon Musk's whisper number target for the end of this year of maybe 2 million vehicles to be produced and delivered, a little bit above the official number. On the year, the stock well off of its highs, nonetheless, still up 97%. So it's going to be interesting to see whether or not this story weighs on the stock as time goes on.
Yeah, I think it's absolutely fascinating because, of course, those cars are assembled in China and then exported out. But all cars have a ton of parts that are made in China. They're just assembled elsewhere. So I guess it depends on how important you think the actual assembly process is. Abigail Doolittle, thanks very much for that. Turning now to the sports betting industry, JP Morgan upgraded DraftKings to overweight from neutral, writing that the company has, quote, a strong product, scale, and brand that should allow it to compete against new entrants like Penn's, ESPN Bet, and Fanatics, and like it competed against Caesars. Bloomberg's Katie Greifeld joins us now for more on sports betting. Katie?
Yeah, Matt, you can see that DraftKings currently up about 3% after that vote of confidence from JP Morgan, like you said, upgrading DraftKings to overweight from neutral. And analyst Joseph Greff saying that basically buy into the stock's recent weakness. If you look from late July into yesterday's close, DraftKings had been down about 16%. But the sports betting industry overall is attractive right now. The industry as a whole is cutting its expenses, and specific to DraftKings, like you mentioned, it has a strong moat in that product, scale, and brand. You add that all together, and that should allow DraftKings to successfully fend off some of its competitors here, which seem to be growing by the day. JP Morgan, rather, it also boosted DraftKings' year-end price target to $37. Previously, it had been expecting DraftKings to end 2023 at about $26. Currently, shares trading, as you can see, at about $28.30.
All right, Katie, thanks very much. Katie Greifeld there on DraftKings. Now let's get over to the beauty industry. Coty fluctuating after launching an offering of 33 million shares as part of its plan to add a Paris stock listing. Bloomberg's Simone Foxman joins us now for more on Coty. Simone?
Yeah, Matt, Coty making this announcement yesterday after the closing bell, talking about how this offering would be to the public in the United States and via private placement outside of it. But really, this is a part of that plan to list on Euronext Paris. And the idea behind this offering would be that it would open the company up to a new class of European investors. Paris is where the company was founded back in 1904. It's also the place, EMEA at least, where the company does about 45%. That's the largest segment of its overall business. And in May, the company calling Paris the historic home of beauty. And so offering there would allow the company to trade alongside LVMH, L'Oreal, Hermes, Kering, etc. It is a plan that the company has been floating for a while, and now particularly a good time to do it, perhaps because the company last week raising its revenue guidance for the first half as well as for the fiscal year, looking at 10 to 12% growth in sales just for the second part of this calendar year, with especially strong launch of Burberry Goddess fragrance. Shares are close to 3 times the value they were when Tsunabe, the current CEO, came in September 2020 to try and rebuild this company. We're seeing a little bit of a reaction here today, a negative one on this dilutive impact. But overall, this has been a really positive market story so far this year. Shares up 34% despite some of those declines today, year to date.
All right, Simone, thanks very much. Simone Foxman there talking to us about Coty. Let's turn back to the Fed. Why don't we? The market's been open for 3.5 minutes already. Aaron Kennan of Clear Harbor weighing in on a higher for longer narrative, writing, quote, the Fed's approach to their last meeting was to announce data dependency, yet suggest they are inclined to see the whites of disinflation's eyes before they cut rates. We know why they are taking this more hawkish approach, as they enter the inflation fighting process too late and received heavy criticism from market observers. This increases the profitability that they overstay, or sorry, the probability, I should say, that they overstay their welcome. And really, do they have any other choice? Aaron, I'm pleased to say, joins us now. They have to err on that side, don't they, Aaron? Because if they don't, and then inflation comes back, I mean, Jerome Powell's worst fear must be to look like Arthur Burns.
Sure. Yeah, Matt, thanks for having me. Certainly, that is a concern. Powell has made reference to that he's going to be more of a Volcker in this regard. But I do think this economic picture is certainly far different than the one that we saw in the late 70s and the early 80s. And so I think the Fed is jawboning the market. I think they're doing what they want to do. They pulled the growth forecast up, and they removed the 2 rate cuts in 24 in their dot plot. And I think that doesn't speak to the reality, which may be that growth does really start to tank in 2024, and the Fed needs to pivot. And I think they're willing to do that. They've shown that in the past, but they have certainly convinced the market that they're not of that mindset at the moment.
So they have 2 mandates, obviously, employment and inflation. Is one more important than the other right now?
I think the Fed is clearly focused on the inflation picture. And I think that, while they are now of the view that maybe we can experience a soft landing without having an employment crack, we'll have to see how that all works. Employment's usually the last leg of the stool to drop as we go into a recession. And I think that that's really been the narrative of 2023, which has surprised the markets, which is the resilience of growth. We have seen inflation drop significantly, Matt, and from that 9% odd headline number back in 2021 to, now below 4%. And PCE month over month, if you look at that data set, is pretty close to the Fed's target. So we've made a lot of positive gains in the marketplace, and yet, bond yields are higher this year, which has been quite surprising. But I certainly think that the Fed's looking at the dual mandate. They certainly would rather not see employment crack and see inflation move down. But we've made a lot of progress on the inflation front. I think the Fed's aware of that, and they're more inclined to pause, maybe raise rates another 25 basis points. I think the sort of risk reward of is about equal, where they raise 25 basis points within the next 6 months versus cut 50 basis points within the next 6 months. But again, they're certainly not going to comment on that until they see growth crack.
What kind of crack? What do they need to see, Aaron, in order to start cutting rates?
Well, I think we're starting to see the consumer certainly under some pressure, whether it's the savings rate, whether it's the the lines of credit on their credit cards. You can see the revolving lines of credit extending. You see mortgage rates well over 7.5%. But as some data indicates, which is I believe is accurate, only about 9% of American mortgages, American households that have mortgages are over 6%. And the vast majority are into that 3 and 4% mortgage rate because we've locked them in prior years, which is one reason why there hasn't been much mobility in the housing market. But it's another reason why monetary policy does work with a lag. And it may take some time, but I think what we anticipated seeing in 2023, which was a modest recession, or the increasing likelihood of one, may just be delayed to 2024 as these sort of forces come home and are brought to bear in the market. You have credit card rates, Matt, at 21%. And you start to see the retail sales data has been weakening, and the weekly wage data for the monthly wage data for the month of August suggests that there's far less buying power occurring on the wage front too. So we anticipate a slowdown in 24.
You know what? I am in the habit now, Aaron, of listing all of the headwinds that we have for growth, from depleted savings to credit card usage to, auto loan delinquencies. On the other hand, we've seen oil rally up to $90 a barrel here. You see gas prices continuing to rise, and conventional wisdom is that suggests an economy that's growing. Is that what's happening here?
That's a great question. I believe that has been conventionalism because over the course of history, that there's been a high correlation with economic growth and the directionality of oil. This coming year, and maybe even starting, with the most recent upward move in oil prices, may augur a different narrative where we see tight oil supplies globally, and we have participants who control that incremental production who are less than friendly to the Western world, and particularly at a time of geopolitical uncertainty, strife between, the United States and China, but particularly the war in Ukraine and the ability for Putin to sort of crack the Western alliance's will, I think is perhaps on his mind. He certainly could do it by reducing or removing for some short period of time oil production, exporting from Russia to places like India and China. And in doing so, we could see a significant spike in oil, even as growth is expected to trend downward in 2024. More markedly in the United States, we expect growth to go from 2% to maybe the first 3 quarters. We could have negative growth in 2024. Global growth may be less impacted in 2024 just because of the fiscal stimulus here in the United States has been so strong, and that's starting to peter out. But I do think that there's a real risk that oil prices trend higher in the midst of a slower global growth picture due to these decisions that may be made by less than friendly people in the world.
Well, we could see auto prices go higher again. Aaron, we barely recovered back to MSRP, but this strike could push that, as well as wages for at least 150,000 people. I would expect more as non-union shops look and say, I want that pay. Are you worried about the inflationary pressures of this, potential inflationary pressures of this UAW strike?
I think it's something worth certainly monitoring. It's something that we have been, closely monitoring. But, at the end of the day, we think that, when we look sort of medium term, long term, it's probably less of an impactful narrative on the overall economy, even though it's certainly headline news of late. The president's going out there and striking with the workers. I think most market prognosticators and media people would not have predicted that even 2 weeks ago.
Well, we may not have thought a few months ago that the government would essentially strike due to some Congress people who don't want to vote for funding. Is that going to be a concern at all, or is this just kind of par for the course now?
It's interesting. There's been jockeying around government shutdowns for years. The last one didn't seem to rattle the market. I fear that we are on a sort of walking a high wire act as it pertains to this constant sort of kicking the can down the road on on the shutdown plans. I mean, it seems like the narrative right now is that there's a temporary 4 to 8 week potential fix in the works. I mean, we're the largest economy in the world. The world looks upon us for leadership, and we have people in Congress who can't sort of recognize that compromising and moving down the ball down the field on behalf of the American people is in the best interest of our country. It's quite sad to see it.
All right, Aaron, thanks so much for joining us. Aaron Kennan there from Clear Harbor talking to us about the Fed and the various pushes and pulls affecting that body. Coming up, lawmakers scrambling to avoid that shutdown we were just talking about.
Our partisan politics are not going to resolve this issue, let alone really confront the huge fiscal issues that are the things we should be talking about. Our politicians are promising not to do the things that we actually have to do to fix the budget.
Our team coverage up next. This is Bloomberg.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's always for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy, but man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Just a few months ago, the Speaker of the House and I agreed to spending levels for the government. We were up right to the very edge, almost reneged on our debt, and that we're going to fund essential priorities and still cut the deficit by $1 trillion over the next decade. Now, a small group of extreme House Republicans, they don't want to live up to that deal.
I'd be shocked if the Senate passed anything. They were supposed to pass any appropriation bills for the last 3 weeks. They haven't passed one.
It is crunch time on Capitol Hill. The Senate nearing a deal on a short-term spending measure intended to avoid a government shutdown at the end of the week. They have to do the work because the House apparently isn't. There, moderate Republicans are teaming up with Democrats on a rarely used procedure to force a vote on the floor. We'll see if that works. But in the meantime, Moody's signals confidence is wavering ahead of Saturday's midnight deadline, writing a shutdown would, quote, underscore the weakness of U.S. institutional and governance strength relative to other AAA-rated sovereigns. Let's get to our team coverage. Bloomberg's Kaylee Lyons and Anne-Marie Hordern are in Washington. And Anne-Marie, first walk us through what the Senate bill is going to look like and how this would work and for how long.
Well, Senate Republican and Democrat negotiations have been working through the weekend, and when they're back this morning, they plan on voting on the FAA reauthorization bill. That bill can serve as a shell to put through a stopgap funding measure to keep the government working. This is federal spending that is going to run out after September 30th. It would be for 4 to 6 weeks. Questions remain on whether or not disaster relief will be included or Ukraine aid, which you do know that some members on the House Republican side say they cannot vote for. But really what this comes down to is if the Senate is able to pass this through and they send it over to the House chamber, will Kevin McCarthy, the Speaker of the House, put it on the floor? Because if he does, this will likely be a centrist vote. Moderates from both parties will vote this through. But it is the hard right flank. Some members have threatened to oust him over putting a bill like that on the floor. So then this would become a very tricky pickle for him to get out of.
Yeah, God forbid some legislation go through in a bipartisan vote. Kaylee, is there any way the House can force the vote?
There is, Matt, but it is a very difficult one to execute procedurally. This discharge petition has only been successfully used twice this century. Basically, it would require all the Democrats in the House plus 5 Republicans to get on board with this discharge petition that would go around Speaker McCarthy. The thing is, even once it gets all requisite signatures, 218 of them, they still need to wait 7 legislative days to actually bring it to the floor. So there is no way that this would work in time to avert a shutdown on October 1st. We have to keep that in mind. It also could have pretty catastrophic political consequences for Speaker McCarthy. As Anne-Marie says, he's in quite a pickle. Matt Gaetz, the Republican from Florida, told me and a group of reporters last week that any Republican who works with Democrats will be signing their own political death warrant. That really just speaks to some of the dysfunction we are seeing on Capitol Hill at the moment. And it's that very same dysfunction that triggered that warning from Moody's yesterday. They talk about weakness in governance and political partisanship, that really polarization. That is why they are saying the creditworthiness of the U.S. may be in question. Remembering, of course, Matt, Moody's is the only of the big 3 ratings agencies that hasn't downgraded the U.S. Fitch and S&P have done the same, both of them citing governance and discord in Washington as the reasons why.
All right, really interesting stuff. Obviously, we're going to be following along. Anne-Marie Hordern and Kaylee Lyons, thanks very much for that. Now, for some of the sector price action that we're seeing this morning, since the stock market has been open for 22 minutes, let's get over to Bloomberg's Abigail Doolittle. Abby?
So we're seeing a bit of a sell-off here for stocks. Not a major one, Matt, but we do have the S&P 500 down about 0.8%, down 5 out of the last 6 days, down more than 6% from the late July peak. Sector-wise, you can see right there, a sea of red on the screen. All 11 sectors are lower. We have a few of them down by about 1%. Those are the mega cap tech sectors. So even though yields are a little bit of a reprieve today outside of the 2-year yield, investors remembering that pain from yields. Over the last 5 days, Matt, all 11 sectors are lower, and it's interesting because real estate down the most, of course, getting hit by those sectors, the yields going higher, making the dividends look less attractive, although discretionary at this point is taking that lead. Financials, too, can't catch a break. Bearish activity.
All right, interesting stuff as this market really has been in a downdraft over the past couple of weeks. Abigail Doolittle, thanks very much for that. Coming up, the market-moving events that you need to be watching out for. That's next in our Trading Diary. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Time now for the Trading Diary. What you need to be watching this week. President Biden joining the UAW picket line at noon Eastern. We'll definitely show you that. Wednesday, the second 2024 GOP presidential debate without Trump. Fed speak picking up Thursday with Chair Powell, Goolsbee, Cook, and Barkin. Plus, we'll get U.S. GDP and another round of jobless claims. And finally, the government shutdown deadline coming at midnight on Saturday. This was the countdown to the open. For Jonathan Farrow, I'm Matt Miller. This is Bloomberg.
What do you worry most about your economy and Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we got some J.P. Morgan news. We're going to delve into that. Some issues there with that with Jeffrey Epstein. Ira Jersey, Chief U.S. Interest Rate Strategist, he's going to join us as well and give us a sense of kind of what this Federal Reserve is thinking about as it parses all this economic data. And then Dana Peterson, Chief Economist at the Conference Board, she's going to join us to talk about the latest consumer confidence data, which is just hitting the tape right now. So we got a lot coming up, a lot of data, a lot of interesting stories, and then we've got the markets. And let's kick off our discussion right here with Amy Morris and get a Bloomberg Business Flash.
All right, thank you, Paul. Tesla's Chinese exports are a target of an EU anti-subsidy probe. We get more on that with Bloomberg's Abigail Doolittle.
The EU conceivably trying to protect some of their own automakers that are pushing and producing EVs that are generally perhaps a little bit more expensive than some of the ones coming out of China.
That investigation focusing on determining whether and to the degree to which China has subsidized Tesla, as well as domestic manufacturers. Tesla shares down little less than 1% now. We check the markets for you all day long here on Bloomberg Radio. The Dow is down 0.5% or 174 points. S&P 500 down 0.8% or 36 points. And NASDAQ down 1% or 132 points. The 10-year yield at 4.5%. The 2-year yield 5.13%. NYMEX crude oil at $89.73 a barrel. That's a gain of 5 cents. And Brent crude is down 9 cents, now trading at $93.21 a barrel. COMEX gold, $1,927.30 an ounce. That's down by about $9.60. I'm Amy Morris. That's your Bloomberg Business Flash. Paul and Matt.
All right, Amy Morris, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in a Bloomberg Interactive Broker Studio, streaming live on YouTube. You can just head over to youtube.com and search Bloomberg Radio. So, Matt, we got some news crossing the tape here. J.P. Morgan settles with Staley, U.S. Virgin Islands, to end Epstein legal woes. J.P. Morgan Chase reached settlements with former executive Jess Staley and the U.S. Virgin Islands over ties to Jeffrey Epstein as it seeks to end its legal woes over its banking relationship to the deceased pedophile. The biggest U.S. bank tentatively agreed to pay $75 million to the U.S. Virgin Islands. That's according to the statement Tuesday, less than half of the $190 million of the territory it sought. So let's kind of break this down a little bit, and we can do that with Elliot Stein. He's a senior analyst of Bloomberg Intelligence, following all the legal issues for BI. Elliot, I guess this, if nothing else, does put an end to kind of what J.P. Morgan sees as a very bad part of its history.
Yeah, I mean, this has been a sordid saga ever since Epstein was arrested. And then late last year, you had both Deutsche Bank and J.P. Morgan sued both by the victims, Epstein's victims, and then J.P. Morgan was also sued by the U.S. Virgin Islands. Both banks settled with the victims previously, and now we have this settlement, which should put an end to at least, the litigation against the banks.
It's unclear what the settlement with Staley looks like. So we know that in terms of the U.S. Virgin Islands, the bank has at least tentatively agreed to pay $75 million. They're not admitting any wrongdoing, I imagine, but when you fork over $75 million, that says something in itself. In terms of Staley, I don't get whether this means that he is going to pay them, and certainly they haven't released any terms.
Yeah, I mean, presumably there's some sort of monetary component to the settlement between J.P. Morgan and Jess Staley. They were
coming from Staley to J.P. Morgan.
Right. J.P. Morgan was, they were saying that they were really only on the hook because of Jess Staley's involvement with bringing in Epstein into the bank as a client, and that as a result, the bank was, vicariously liable because of his actions. And so they went after him for a few things, breaching his duty to the bank by not telling the bank earlier about what was going on, and then seeking any contribution for any payout that J.P. Morgan was going to make.
Well, for convincing them to keep Epstein as client. Everyone knew what was going on. I mean, his the prosecution and his conviction in, 2008 was public knowledge. So everyone knew.
Right, and that was the problem for the banks, that there were red flags. I mean, there was no, concrete evidence that he was, doing sex trafficking with children, but there were enough red flags, part of which was because he had a prior conviction.
All right, Deutsche Bank also paid, didn't they? I seem to remember them being involved.
Yeah, earlier this year paid about $75 million to the class of victims that had sued Deutsche. JP Morgan also settled with that class of victims for about $290 million. And that was earlier in the year, in the spring and in the summer. And then this case, the U.S. Virgin Islands case against J.P. Morgan, was going to go to trial in October. So actually, I wrote just a couple weeks ago that it looked like this case was on the path to settlement because neither side wants to go to trial in a case this salacious.
Yeah, it's the last thing if you're J.P. Morgan you want to have, and then have Jamie Dimon dragged into this.
Exactly, right. These are not facts anyone wants to come out in court.
So I guess from J.P. Morgan's perspective, is this issue behind it now?
I think so.
Because you've settled with the victims, or the class of victims, I guess, right?
Yep.
And if you didn't join that class, do you have any standing to come back and try to do something again?
No. The settlement is like you either opt into the settlement or you don't.
Okay.
Well, they were sued by this class of victims,
right?
And they were sued by the U.S. Virgin Islands,
right?
Who knows if some other group will come and sue them as well?
Yeah, it's hard to envision what group that would be, and there's always statutes of limitations too, which sort of put a cap on when lawsuits can be brought. So at this point, given this resolves everything that's out there right now for J.P. Morgan related to Epstein.
All right. That's interesting news. Just crossing the tape here, so we want to dive into it and see what the impact will be for J.P. Morgan. But I guess if nothing else, it puts that legal issue behind them. Elliot Stein, thanks so much for joining us. Elliot Stein is the senior analyst with Bloomberg Intelligence. He went to Stanford, so that's Pac-12, right? Stanford, Cal, all that kind of stuff.
Yeah.
Guess what? The Stanford Cardinal now has to come to the East Coast because they're playing in the ACC going forward. How stupid is that?
Well, yeah. They're coming closer to me, so I appreciate it.
It's good for you, I guess.
It's good for me. I can see more games.
But it doesn't make any sense.
It makes no sense.
Historically.
So I'm going to ask the volleyball team, some of these young ladies, to travel 2 days to get here, 2 days to get back for a volleyball game against NC State.
And
well, dude, they're not driving.
And do the East Coast teams want to go to the West Coast? Probably not.
I always see these kids in the airports, these teams from all these schools, and there's it's not like the football team where they get their own charter or anything. The basketball team, it's the volleyball team, it's the soccer team, it's the golf team or whatever, and they're always like sitting in airports, huddled up, trying to study and everything. I just can't imagine this cross country stuff. Of course, USC and UCLA, they get to come to Piscataway, New Jersey to play Rutgers. How good is that? All right, Elliot, thanks so much for joining us here. Let's talk to Ira Jersey here. Why? Because we have to. It's in our contract. We have to talk to Ira.
Well, one thing we can talk to Ira about is Jamie Dimon, having nothing to do with Jeff Epstein in this case, but having to do with his comment to the Times of India yesterday, which I thought was pretty amazing. Now, I don't know if it was prompted, but he said he pulled a 7% out of the blue for a potential Fed rate. And right now, a lot of people don't even believe 5.6%.
Well, maybe he knows something that the rest of the market doesn't.
I don't know. Ira, what did you think about that comment? Jamie Dimon saying, this economy is not ready for a 7% Federal Reserve Fed funds rate. 7%? Where did he get that?
I mean, it's not. I don't know where he got that comment from. At the end of the day, we were at 3%. He thought we were going to 5% about a decade ago, and we went to 1%, right? So, forecasting interest rates is always fraught with peril. I mean, regardless of if you're an investor, if you're, professional forecaster like myself and others, because there are so many variables that go into it. Now, that being said, if the economy and the world isn't ready for 7% interest rates, then the chances of you getting there is incredibly small, right? And I didn't hear those comments. I only saw the headlines, so I'm not 100% sure what context they were said in. The recent move has been pretty dramatic, and certainly has a lot of people like ourselves reassessing our view on interest rates and where we're going to be heading, because obviously the Fed last week was a little bit more hawkish, particularly that dot plot, but at the same time the market is still thinking that the Fed at some point is going to be cutting interest rates, just not as dramatically as it had thought before. So that's one reason why you've had this little bit of an uninversion of the yield curve, but you still have the 2-year, 10-year at inverted by 60 basis points. It's just everything shifted a little bit higher now.
One of the things that the Fed pays attention to, the markets pay attention to, is the consumer. We had some consumer confidence data came in slumped to a 4-month low in September. So the Conference Board index declined to 103 this month from an upwardly revised 108.7 in August. So I bet the Fed pays attention to the consumer, don't they, Ira?
Yeah, so obviously retail sales and consumer spending is a vast majority of the economy, and the retail sales growth tends to lead inflation, right? So the more the consumer is buying of non-energy goods and services, the higher prices go, right? So if we do see the consumer start to pull back and be less confident, and actually spends their confidence, which you don't always do, by the way, then you'd expect maybe a bit of a slowdown in economic activity. But Paul, it's important to remember that consumer confidence is often has to do with oil, right, and energy prices. So as you get higher energy prices, the consumer becomes less confident in their current expectations for spending and the like, and that's why we always mention that higher gasoline and energy prices tends to be like a tax on the consumer, because you spend more on something that you almost have to spend money on, at least in the current regime.
I wonder what you think about what pushes the Fed to cut rates when they finally get there. Because they're not going to just do it if growth is fine and unemployment isn't rising, just to have lower rates, right? There needs to be a catalyst. Something needs to break.
Yeah, either something needs to break, or you need to have what breaks. It might be the consumer, right? It might just be a pretty dramatic slowdown in economic activity that leads to lower inflation and more unemployment and companies laying off people, right? And so one of the interesting things is we keep on talking about the potential for there being even more inflation because of things like the UAW strike and the writer's strike, and just input costs to a lot of goods and services going higher because of higher wages. But at the same time, profits are going to be squeezed in that situation. So therefore, there might be cost cutting, and labor is obviously something that can be cut pretty quickly by companies. But but again, we have these issues that we've been talking about now, for a year, where there seems to be a bit of a labor supply shortage. So people might be more reluctant to do that. But once they do, that's probably the impetus for the Fed to cut. So the Federal Reserve, remember, they have two mandates. They have to keep prices stable, and they need to keep full employment. And as long as there's not significant job losses, I don't see any reason for the Fed to cut. Some people have in their forecast, they think that as inflation goes down, maybe the Fed will adjust their interest rates a little bit lower to kind of get the difference between inflation and the Fed funds rate and keep that the same at 2.5–3%. I'm with you, Matt. I don't think that they'll do that. I think that they'll wait until they absolutely have to cut, and then when they have to cut, they'll probably have to cut aggressively. So I think it's the idea that the Fed might remain on hold for all of 2024. That's still our base case at the Bloomberg Intelligence U.S. rates team. We don't think that the Fed's going to cut until 2025 at the earliest.
All right. I wonder what you think, Matt. If you just get a sense that the markets feel like, okay, we're done hiking, is that enough for risk assets to rally?
I don't think so, because the markets do feel like that, and we've seen the opposite, right? They're concerned that the Fed isn't going to cut as much, at least in terms of the dot plot, as they previously expected.
So in your market here, as I look at the 2-year at 5.13%, does it stay around these levels until the Fed starts cutting, or is it like the stock market where it anticipates maybe 6 or 12 months down the road?
Well, it does anticipate, and Paul, to your point, like the anticipation was, for just as an example, for 2-year yields to be at around 4.5% in a year's time. Now that's 4.75, right? So those have come up, and in part because of what the Federal Reserve has done, and also in part just the idea that maybe the economy is going to sputter along here a little bit. And you've seen the same thing in the longer end of the curve too. In fact, I'm working on my outlook for the month of October right now, and as I was looking at things like the futures on SOFR, so short-term interest rate futures, those have priced out 30 basis points of interest rate cuts from by the end of next year, right? So when we look at those forward anticipation of what the market's telling us, we have priced out some of the cuts that were anticipated, and I think to Matt's point, that's what's feeding into this feeling in some risk asset markets, whether it's commodities or certainly the equity market, is just the fact that the Fed's not going to be as easy as everyone thought. So you have to adjust your valuation outlook for that too.
I mean, I assume you see more volatility at the front end of the curve, but lately we've seen investors kind of do an about face. They were going long duration, and now it looks like they've reversed that, or how do you see that?
Yeah, investors definitely were long. You look at things like even the JP Morgan client survey, investors still are leaning probably a little bit long. When we broke a very important technical level at around 4.35% on the 10-year Treasury. So after that, you wound up having, people who are long stop themselves out, particularly a little bit above that yield. And so I think part of this move recently in the last couple of days is technical, but you also have a big global component to this. So you have, Japan talking about ending yield curve control. You have an ECB that's dealing with a potential stagflationary environment, even though inflation there is coming down relatively quickly. They are still likely to keep interest rates higher than people thought for some period of time. And all of those things are feeding into, people selling duration, not only here in the U.S. We have to keep in mind, this is not a U.S.-centric move. This is a global move where you've actually seen these moves begin during European hours, and they just continue during U.S. hours. But it's European and Asian selling that kind of kicks things off and has the last couple of big moves higher in yields that we've seen.
What's the soccer match you're most anticipating over the next several days, Ira?
Well, Real Central New Jersey Soccer has a U.S. Open Cup qualifying match. So even though tomorrow night is Lionel Messi and Inter Miami in the finals of the U.S. Open Cup, we start the qualification rounds for next year's tournament on this Sunday. So that's what I've been focusing on, watching some videotape and getting the guys ready for that match on Sunday.
And where do you play this match?
It's in Ambler, Pennsylvania, Temple Ambler. We're playing the German-Hungarian club, one of the oldest clubs in the country. Yeah.
Perfect. All right. I mean,
that's awesome.
You can't get that anywhere else.
I mean, playing the German-Hungarian club in Ambler, Pennsylvania.
You think they'll be having some German beverages afterwards?
I feel like they're probably going to have German beverages before, during, and after.
All right. Ira, good luck this weekend with your match. Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence, also our Chief Soccer/Football Strategist as well.
He's going to have some bratwurst this weekend.
Yes, exactly. Brat and a stein of beer. Good for him. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Tesla's in the spotlight of the European Union's anti-subsidy probe into Chinese EVs. Bloomberg's Kriti Gupta has more from London.
The question is, if you have all of those Chinese vehicles flooding the market, where is the demand for European vehicles? And that's the concern here behind this headline. That Tesla's Chinese exports are now a target of the EU anti-subsidy probe. Essentially the idea that, well, the EU, Tesla, is a dominant player in the Chinese market, and that's creating some trouble with the EU.
All right, checking in with Tesla shares right now. They're down about 1%. Well, the maker of Febreze air freshener has escaped a copyright lawsuit. Bloomberg's Gina Cervetti has the story.
Procter & Gamble has avoided a copyright lawsuit over its Febreze jingle. A federal appeals court said songwriter Cameron Cates failed to show that the notes in overlapping 5-note sequence allegedly stolen from his song warranted copyright protection. The court said that even if Cates could show copying of the 1982 song She Loves Her Job and I Love Her Too, the small portion of his song was not enough for the works to be substantially similar.
and shares right now are down about 1%. And Roku and Samsung, they're being sued over technology that targets ads to specific viewers. According to the lawsuits filed by Anonymous Media Research Holdings, the companies allegedly infringe patented data analysis techniques that let advertisers deliver messages to smart device users based on their viewing or listening habits. Right now, Roku shares are down about 0.5%, Samsung down about 1%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm Amy Morris with the Bloomberg Business Flash. Liberty Media proposed splitting off the business that houses SiriusXM and then combining it with the rest of SiriusXM Holdings. Shares of SiriusXM now down nearly 3%. We check the markets for you all day long here on Bloomberg Radio. Dow down 0.8% or 268 points. S&P 500 down more than 1% or 48 points. NASDAQ down 1.2% or 165 points. The 10-year Treasury at 4.51. Two-year yield at 5.12. And the NYMEX crude oil now trading at $89.60 a barrel. That's down 9 cents. Brent crude down 19 cents, trading at $93.10 a barrel. The euro at 1.0592 against the dollar. British pound at 1.2181. The yen at 148.83. I'm Amy Morris. That's your Bloomberg Business Flash. Paul and Matt.
Amy Morris, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. Bloomberg Markets today is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Lots of economic data came out today. Consumer confidence numbers came out a little bit weaker than expected, weaker than last month. Expectations also a little bit weaker. The present situation a little bit better. So we got a little bit of a mixed bag here. Let's break it down with Dana Peterson, Chief Economist for the Conference Board. Dana, what do we know about the consumer right here, right now?
Well, we know that they're very much concerned about the future. Indeed, the expectations gauge fell back below 80, which is a threshold that usually signals recession within the next 6 months or so. When we ask them what are they thinking, consumers are still complaining about high inflation, especially food and energy prices. And they're also worried about the jobs market, given the fact that we're seeing slower payrolls, fewer job openings, and fewer people are even quitting at this point.
So no one's quitting. And are companies laying people off? I mean, the consumer looks pretty stretched right now, and I guess layoffs would be the last thing you need to see.
Well, the labor market's kind of mixed. I see it in three buckets. Yes, you still have some companies that are still hiring, like healthcare, hotels, restaurants, and you do have some companies that are letting folks go, especially finance and tech and even warehousing and transportation. But a good chunk of companies are holding on to people. That's called hoarding labor. And that's because they think, yes, there will be a downturn in the economy, but it won't be that long. It won't be that deep. And they don't want to have to scramble again to find good labor at affordable prices. So they're holding on to workers. But certainly, we do think that payrolls probably will start to go negative either late this year or early next year.
Have we ever seen that hoarding of workers before? I can't recall it being any kind of major phenomenon.
No, and the reason why is because this is the first time we've had major labor shortages. Why are we having labor shortages? A lot of it has to do with the fact that baby boomers are retiring. They're leaving the labor market, and especially in places like construction and manufacturing, those older, highly skilled workers are exiting. And so companies are trying to hold on to the best people that they can by raising wages. And that's a negative, certainly when you think about inflation.
You're not a baby boomer, though.
I just get in the...
What's the last year for baby boomers?
I think 64, and I'm December 63. So
you just slid in under the wire.
Slid in, yeah.
Okay, exactly. Boomer.
Exactly.
In terms of the consumer, Dana, there are all these concerns about depleted savings. I guess that's still a bit of a debate, but we're almost there, right? Credit card debt, they're putting more and more purchases on plastic. Delinquencies are starting to tick up on in a number of different categories. How is the consumer right now? Because a lot of people who are bullish say, well, the consumer wasn't that strong in past expansions anyway, so this doesn't necessarily portend a recession.
Well, I think what's different this time, and economists are always saying this time's different, is that you had a lot of support for consumers during the pandemic from fiscal stimulus. You had checks, you had credits, you also had student loan forbearance. All of those things are going away at this point, and it's going to be a shock to the system, especially lower income folks who, yes, are using their credit cards. And by the way, those credit card balances are much more expensive to carry because interest rates have risen dramatically over the last year.
So talk to us about rents here. I mean, or in home equivalent costs. Rents here in New York City are still crazy, but I understand in some other parts of the country they're coming down. What's the cost of housing these days for the consumer?
Sure. In aggregate, yes, rents are rising less aggressively than they were before. And that's showing up when we look at the consumer price index as well as the personal consumption expenditure deflator. And that's good news for the Fed. But it's going to take time to really work through the system. And so it's going to play out over the next year or so. But it certainly is good news. The bad news is that home prices, which wind up appearing in rents with a lag of about 18 months, are starting to tick back up again. And so we could see maybe late next year or early in the year after that, more upward pressure on rents. But for now, rents are going in the proper direction.
I wonder if employers if we get a soft landing, is the hoard labor call wrong? I mean, if it's very soft, do they then start to let people go?
Well, it all depends on the industry. So if you're in an industry where you have lots of older workers who are leaving, then it wasn't a bad call. But if you're in an industry that maybe overhired and overextended yourself, especially during the pandemic, you might continue to let people go or start letting people go, realizing that maybe there isn't as much demand out there.
So, Dana, at the conference board, are you guys forecasting a recession? And if so, when and maybe how severe?
Sure, we still have a short and shallow recession priced in for the first half of next year. We're looking at GDP prints just below zero, really, and most of it's going to be weaker consumer spending and business investment. We also may have a hit from government, certainly with the debt ceiling, agreement. There was across the board cutting that we could see starting potentially late this year or even early next year. So we have all these factors going on. Plus, we don't expect the housing market to really come back online until interest rates start to fall. So all that does shape up into this short and shallow recession that we anticipate.
All right, Dana, thanks so much for joining us. Really appreciate you coming on, shedding some light on some of the economic data that we received today. Again, consumer data out today. Dana Peterson, Chief Economist at the Conference Board. All right, so I'm back to the Matt Miller Garage Watch. What's next to arrive? Is it going to be the motorcycle?
Well, so the Dodge Challenger RT Scat Pack wide body has been built and is shipping apparently.
Okay.
So that could arrive at any moment. And I'm hoping to get it before the end of the week because I want to drive home to the great state of Ohio. You've got a break-in period on these things, or at least a lot of people believe a break-in period is necessary. I'm not sure if you need to do that to a modern engine, but of course this 6.4-liter Hemi is not terribly modern. So I would like to use that trip as a break-in.
Now, does the family come along in this Challenger?
I'm going to drive home with my 2-year-old daughter.
Okay.
And there's one issue, which is that she sits in a rear-facing car seat.
Yep.
And you're not supposed to put those in the front seat.
Right.
It's dangerous because of the airbags. But I've heard if you disconnect fuse number 10, that turns the airbag off. So I feel like maybe that's a way to make it work. I've got to check with
because there's no real viable rear seat in the Challenger.
There is, but it's just hard to put a baby into a rear-facing car seat back there.
I don't think the Challenger with the Scat Pack was designed to carry.
It definitely wasn't.
Okay.
This is more for, I guess, teenage kids.
Okay.
Anyway, so that's one thing that I'm contending with. Now, the rain has made the other vehicle arrival difficult because I need to go and pick up this Indian Chief Bobber Dark Horse.
Sure.
Which I'm looking forward to getting in the garage.
And where is this?
Well, it's not far away. It's out in White Plains, and that's only a 10-minute Uber from me. But I just haven't wanted to go when it's pelting down.
Right. Okay. All right. So we got that to contend with. Now, is there going to be a break-in trip for the motorcycle?
No, that doesn't really require such a break-in. And then the vehicle that I'm really building, next vehicle building and looking forward to is the BMW X5 X-Drive 50E. This is the hybrid solution to the family hauler. It's got the classic, the famed, BMW inline 6-cylinder engine that we love so much, both of us. But it's also got battery power, so the wife can drive it around for like 30, 35 miles without the gas engine kicking in. But then we can also take it on a long trip without having to find chargers and stop and spend an hour.
So this will be a replacement for the existing what?
For the Volvo XC90, yeah.
Which does the Volvo know it's on its way out?
No, and it's been a great car, but it's only got 2-liter 4-cylinder, and that's like kind of too plain vanilla, too boring for me.
Right, even though your wife's not complaining about it, you're just assuming.
No, she loves it.
Yeah. Okay.
But what does she know?
Oh, man. All right, so again, they've got a lot going on in the garage.
There's a lot happening at the Miller household, you know?
All right.
Some ins and outs.
Yep. All right. Very good.
I still got my all-time favorite, the 2008 Ducati Monster S4 RS Tricolore, sitting there in the most coveted position.
Do you use any of these things other than just driving back and forth to work?
No, I don't even really drive them back and forth to work anymore. So
train. Okay.
Yeah.
There you go. There's the update, folks. Car Talk. S&P 500 off 1% here. Same for NASDAQ. Yields slightly higher. 10-year Treasury yielding about 4.52%, just off fractionally. WTI crude oil up a little bit, right at $90 per barrel. With our news in New York City, here's Michael Barr.
Thank you very much, Paul and Matt. When House Republicans return from their recess today, they'll be working on finding the votes to support a spending bill. Bloomberg's Nancy Lyons reports.
A government shutdown could happen by the weekend if House Republicans cannot come together on a stopgap measure or a spending bill. Far-right conservatives want deeper spending cuts and stricter border policies in any package. White House Press Secretary Karine Jean-Pierre.
We're going to hold them accountable for the reckless cuts they are demanding as a condition for keeping the government open.
Republican Congressman Brian Stile of Wisconsin tells Bloomberg Sound On there will be a deal.
I'm optimistic that at the end of the day, we're going to get there.
Government funding runs out at midnight Saturday. In Washington, Nancy Lyons, Bloomberg Radio.
Meanwhile, the Senate is nearing a bipartisan deal on a short-term spending measure. President Biden will stand alongside United Auto Workers today in Michigan to show his allegiance to labor unions. Reporters shouted a barrage of questions at President Biden about the striking auto workers.
They saved the automobile industry. And I think that now that the industry is roaring back, they should participate in the benefit of that.
Tomorrow, former President Trump will also speak to the workers in Michigan. Another entertainment group is poised to go on strike. Video game voice actors and motion capture performers have voted to authorize a strike if labor negotiation talks with gaming companies fail. The union representing them, SAG-AFTRA, is also representing thousands of Hollywood actors who walked off the job more than 2 months ago, and all of this comes as the Writers Guild of America reached a tentative deal toward a new contract following a nearly 5-month-long strike. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm Amy Morris with your Bloomberg Business Flash. Stock markets are retreating. Investors are pricing in a protracted period of high interest rates, and a sell-off in government bonds is pausing while the dollar is climbing. We check the markets for you all day long here on Bloomberg Radio. The Dow is down 0.7% or 258 points, now at 33,748. S&P 500 down 1% or 42 points, now at 4,294. And NASDAQ down 1% or 136 points, now at 13,135. The 10-year yield at 4.52%, the 2-year yield at 5.13%. NYMEX crude oil has gained now 0.5% or 44 cents, now trading at $90.13 a barrel. Brent crude now up 0.3% or 28 cents, trading at $93.57 a barrel. COMEX gold at $1,925.90 an ounce. That's down $10.60. And the euro at 1.0588 against the dollar. The British pound 1.2178, and yen at 148.84. That's your Bloomberg Business Flash. I'm Amy Morris. Paul and Matt.
All right, Amy, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Definitely a risk-off feel to the market here today, again, as the high interest rate environment seems to be here for longer is what the market's pricing in. Let's check in with somebody who has an informed opinion on this. Brent Schutte, Chief Investment Strategist for Northwestern Mutual. Brent, what's your call here on what our Federal Reserve is going to do kind of over the next 6 to 12 months?
Yeah, I think the Federal Reserve is worried about wage growth. So you have seen the disinflation that we thought would happen. That was largely because the inflation that we had over the prior couple of years was largely tied to COVID. And as we pushed further past that and the economy moved back somewhere towards equilibrium, we thought that inflation would come down, and it has. That's the good news. The bad news is the U.S. economy looks late in an economic cycle. What typically happens late in an economic cycle is that the labor market is tight, which causes wages to grow. And that can lead to inflation being pulled back higher, which I think is the prime worry right now. And so until the Fed sees wages move lower, they are not going to take that liquidity tourniquet off. Unfortunately, the only way that wages have moved lower in the past when the labor market's this tight is through job losses, which we think is a likely outcome in the coming months, which will lead to that recession that we still think is on the horizon.
What do you think about the UAW strike? And, you know, if they come back with wage increases, they're going to be at least 20%, right? Maybe closer to 30. That's, I guess you could say, only 150,000 workers, but people at other shops are going to look over there and say, I want that too. Is that going to be a real factor, or do you not expect it to have kind of a nationwide effect?
No, I mean, I think it's more indicative of where we are in the economic cycle, which is late, where wages rise because there's a lack of workers to fill open positions, which causes that wage growth that the Fed fears about. I think people forget that the inflationary period that the Fed worries about that was so bad in this U.S. economy was called a wage price spiral. And that's where I think we're at right now. And that's why I think the Federal Reserve isn't going to stop. They're not going to loosen policy until they see wages pull back. Right now, wages are running at 4.3 to 4.5%, pick your measure. I think in an interview a few weeks ago, John Williams, VP of the FOMC, said that 3.2 to 3.5 was more consistent with 2% inflation. And as I mentioned before, the only way that's happened in the past is through a recession. And so maybe this time is different, but I think there are enough things that are flashing red that you can continue to think about that recession coming in the not too distant future.
Well, if that's the background there, Brent, are you advising folks to just go into 2-year treasuries at 5.13%? That doesn't seem like a bad place to be.
Well, we have been repositioning towards fixed income for the better half of the last 6 to 9 months. And so we are overweight fixed income and underweight equities. As far as hiding out in the front end of the curve, I would advise people not to do that. I think intermediate term bonds offer value here. They offer a hedge against equity downside risk, which I think will be caused by too little economic growth, which will cause inflation to fall. And so if you think about your Bloomberg aggregate index at 5.35% and a 6 duration, if inflation does fall, think about the difference between 5.3 and 2%. That's where I think there's value right now, especially if you believe, like I do, inflation is set to falter, which I do. I think the good news on the opposite side of that is the Fed will be able to cut rates, but not until they actually see that actual recession happen, which I think is still on the horizon.
How far out the curve do you go? Did you say 6 years? I mean, I know nothing about bonds, like Paul, but I look at 4.85% on the 20-year, and I think, when's the next time I'm going to see that?
Yeah, this is where, so maybe just a little bit more commonsensical. So if you invest in a 2-year right now, so let's take you back to 06 and give you a real life example. In 06, the yield curve was inverted. I believe the 2-year was somewhere around 528, the 10-year was at 524 or something. So it wasn't as big as an inversion today, but think about that person in the 2-year. Think about something called reinvestment rate risk. They would have had to reinvest that 10-year or that 2-year 4 more times. The first reinvestment, I believe, would have occurred sub 2%. The last 3, sub 1%. And so that's where I think just having bonds across the spectrum for an individual, I think is the most appropriate thing. I just worry right now that people are hiding in cash. And you're right. Who knows where rates will be 2, 3, 5 years from now? Perhaps rates are higher now. I don't think we're going back to where we were before, but that's still a kind of an uncertain call. And I think that's reflective of, if you think about uncertainty, you probably want to spread your bond across the curve just a bit and not hide in any one part of the market.
So on the fixed income space, go out a little bit, and is it really, are you staying with investment grade, or are you considering certain parts of the high yield?
No, not high yield yet. I mean, investment grade right now, given that we're headed into an economic contraction, I think you want to stay high quality, especially when those investment grade bonds offer quite a bit of yield. In many cases, yields you haven't seen in 16 to 20 years, which I think, 4 years ago, if I'd have came on your show and told you that, you would have told me I'm crazy. And so that maybe isn't a little bit of a commentary about how uncertain the world can be. And that's where I think, I think people need to reflect that. And I think you need to invest across the curve, but focus more so on intermediate term bonds, just given the fact that you do lock in those yields for a few more years.
When is the right time to buy high yield debt? I mean, if you see a recession coming next year, do you buy in the middle of it, at the beginning of it, at the end of it? When?
Yeah, I think somewhere around the middle of it. I mean, that's where I think, and that's not where it's kind of uncertain about timing. There are many indications to me that the U.S. economy is headed to a recession. I think people are ignoring them because they believe this time is different. There are so many things flashing red right now that, I think a recession is probably, it could happen in the next 3 to 6 months. That's where timing is a bit uncertain. But that's where you just behave better at the end of an economic cycle. And that's where I think you want to be in high quality bonds now. I think the time for owning things that are less than high quality is after they reprice quite a bit, which they haven't done enough so yet.
By the way, I got another credit trader writing in with a question. Since buy rates is sort of consensus decade high yields, how do you outperform your peers if everyone's doing the same trade?
I'm not for sure that is consensus any longer, or is consensus. I think that, the soft landing trade was on the higher forever in interest rates. When I talk to individual investors, they are scared to buy bonds. And I don't think you're seeing a huge rush into the bond market. I hear enough other voices of people like myself who are telling people the opposite, which I think is the wrong answer.
In equities, I mean, the big cap growth stocks have been the winners here this year. Do you stick with them, or do you try to find some value elsewhere?
I think you try to find value elsewhere, and this is where my commentary about liking small and mid is a bit odd, because they are more economically sensitive. This is where I do think there is some good news for equity investors. I think parts of the market have discounted some sort of a recession. And so if you think about most of us on Wall Street, we do have to put money to work every day. And so I think most people have hidden out in those large cap names that they think are economically insensitive, that they're going to grow forever. And that's been the part of the market that has done well. Other parts of the market haven't. Those are small and mid cap stocks. The S&P 600 trades at 12.5 times forward 12 earnings that are down 12 to 13%.
Yep.
And so I suspect that you will see those earnings estimates fall a bit, but I do think there is some cushion there. And that's where I think the opposite side of this could be really good for individual investors in those areas.
All right, Brent, thanks so much for giving us some of your time. Really appreciate it. Brent Schutte, he's a chief investment strategist at Northwestern Mutual. I appreciate getting his thoughts here on the equity side. A little bit underweight and overweight on fixed income. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. JP Morgan Chase has reached settlements with former executive Just Staley and the U.S. Virgin Islands over ties to Jeffrey Epstein. The bank tentatively agreed to pay $75 million to the territory. That was less than half the amount it was seeking. And the agreement with Staley is confidential. Elliot Stein, senior analyst at Bloomberg Intelligence, has the backstory.
This has been a sordid saga ever since Epstein was arrested, and then late last year you had both Deutsche Bank and JP Morgan sued both by the victims, Epstein's victims, and then JP Morgan was also sued by the U.S. Virgin Islands. Both banks settled with the victims previously, and now we have this settlement which should put an end to at least the litigation against the banks.
JP Morgan right now down nearly 1%. And a big blow to Boeing as Airbus lands an offer from Air France. The carrier is purchasing 50 aircraft with an option to buy another 40. Bloomberg's Benedict Camel says it was 7 months of intense negotiations.
The factors that played into this were range, for instance. That was an important factor that played into Airbus's hands. It was price. It was also something like, the availability of the plane, who was able to supply them sooner rather than the other one. So all these factors combined gave Airbus a leg up.
Now, Airbus shares up about 1%. Boeing shares down about 0.5%. And Walmart is rolling out a new prepaid phone service today. Mobile X, which launched earlier this year by a co-founder from Boost, will offer unlimited pay-as-you-go plans starting at just under $15 a month and a lower-cost plan at just over $4 a month. Walmart shares right now, they're down just a fraction. Those are the company stories we're following this hour. I'm Lisa Mateo.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney live here in our Bloomberg Interactive Brokers studio. A sell-off in the markets here today. S&P is off 1%. NASDAQ off a little bit more than 1%. On the yields front, we have the 10-year Treasury pretty much unchanged right here, 4.53% on your 10-year bond. The 2-year 5.14% here. The DXY, or Bloomberg Dollar Index, is higher today, so some strength in the U.S. dollar. Oil finding a little bit of a footing here, up about 0.6%, $90.25 per barrel. With our news in New York City, here's Michael Barr.
Paul, Matt, thank you very much, gentlemen. President Biden heads to a UAW picket line in Michigan today. Biden will be the first sitting president to walk a labor union picket line. Press Secretary Karine Jean-Pierre.
He is the most pro-union president in modern times. That is not something that he's given himself that title. That is something that labor unions have given to him, and he wears that very proudly.
Tomorrow, former President Trump is expected to speak to the same workers in Michigan. The reality of a government shutdown this Saturday is becoming more likely as House hardliners want to see spending slashed. Meanwhile, the Senate is nearing a bipartisan deal on a short-term spending measure. The U.S. Supreme Court left in place a ruling that requires Alabama to have a second congressional district with a near majority of black voters, rejecting the state's latest bid to reinstate a Republican-drawn map. The High Court order reinforces the justice's June 8th ruling against the state. The June ruling tossed out an earlier Republican map as discriminatory and upheld a 3-judge federal court panel decision that required a second majority black district. Alabama argued that the Supreme Court ruling left room for the state to redraw its map without creating the second district. As the weather turns chilly, health experts say we could be looking at another COVID surge. The federal government is once again offering free home test kits to Americans. Dr. Celine Gounder is the editor-at-large for public health at KFF, formerly known as the Kaiser Family Foundation.
As of yesterday, covidtest.gov is up and running again. The government wants to make sure every household has tests on hand ahead of the holidays.
Dr. Gounder spoke to CBS. Global news 24 hours a day, powered by more than 2,700 journalists and analysts over 120 countries. I'm Michael Barr. This is Bloomberg. Paul, Matt.
All right, Michael Barr, thank you so much. We appreciate that. Matt Miller and Paul Sweeney live here in the Bloomberg Interactive Brokers studio. Coming up in the next hour, we're going to check in with Joel Levington, Director of Credit Research at Bloomberg Intelligence. He follows the auto companies from the credit side, so we'll get a sense of how much stress the automakers' balance sheets can handle if this strike goes on for longer. And, Matt, one of the most widely read stories on the terminal, we've called it out earlier today, is Jamie Dimon warns 7% Fed rate still possible. He said that to the Times of India. Boy, I mean, I get the 5% and change where we are now, and maybe even pushing up to 6%. I hadn't seen anybody, certainly not the stature of Jamie Dimon, calling out a potential for 7% Fed funds rate.
It's been a long time since I've even heard 6.
Yeah.
I mean, the speculation, the current bet is whether or not they go one more hike, which would raise the top end to 5.75, so put the effective rate at like 5.6 something. But nobody has been saying 6 lately, and I've never heard anyone say 7, at least not in the last, well, not in my lifetime.
Yeah, exactly.
So I think it's pretty amazing that he comes up with that. He also makes an interesting point, which I guess if you think about it is true, which is that the difference between 5 and 7%, that it means a lot more pain than the difference between 3 and 5, right? Going from 3 to 5, wasn't great, but going from 5 to 7 would be even worse, even though it's only 2 percentage points. But of course, it puts you at a much higher absolute rate. So
yeah, and you're looking at the bank rate, 30-year fixed mortgage, 7.75%. That gets your attention. So Jamie Dimon says, we urge our clients to be prepared for that kind of stress. Is what they're saying over there at JP Morgan Chase. So when Jamie Dimon speaks, you better pay attention because they see pretty much everything out there. A little more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to get the latest. What is the risk to the balance sheets for some of these automakers as they continue on with this strike with their workers? We'll check with Joel Levington, Director of Credit Research at Bloomberg Intelligence. And then Alban Hill, he's the Minister of Industry, Investment, and Commerce for the Jamaican government. He's going to join us in studio to just, Jamaica got a rare credit upgrade, so he'll give us the outlook for that country.
By the way, great juxtaposition with the U.S. since Moody's came out and said, we might downgrade these guys, you know?
Right.
So
and then they upgrade Jamaica. That's very, very cool. And then Matt Winkler, the founder of Bloomberg News, editor-in-chief emeritus of Bloomberg News, he's going to join us. He's got a column out on Japan and Tokyo, so it's always good to check in with Matt Winkler. Right now, let's kick things off with a Bloomberg Business Flash with Amy Morris.
All right, thank you, Paul. The European Union's investigation into electric vehicle imports from China isn't focused just on Chinese automakers. We get more from Bloomberg Global Autos editor Craig Trudell in New York.
They are looking at everybody. And one company really sort of looms largest there as a result of the fact that they are shipping more EVs from China into the European Union than anybody else, and that is Tesla.
That's Bloomberg's Craig Trudell in New York. And right now, Tesla shares are higher, but only just, actually quite little change. We check the markets for you all day long here on Bloomberg Radio. The Dow is down 0.6% or 226 points. S&P 500 down 0.9% or 41 points. And NASDAQ down 1% or 139 points. The 10-year yield at 4.54%. The 2-year yield at 5.15%. And COMEX gold now at $1,924.30 an ounce. I'm Amy Morris, and that's your Bloomberg Business Flash. Paul and Matt.
All right, Amy, thank you so much. We appreciate that. Matt Miller and Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're also streaming live on YouTube, so head over to youtube.com and check out Bloomberg Radio. As Amy was just reporting, a little bit of a sell-off here in the markets. Let's see where the action is under the hood. We can do that with Alex Semenova. She covers the equity markets for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker studio. Alex, what are you looking at?
Happy Tuesday, guys. So I'm looking at Tesla, a little back and forth action today. Earlier, shares were down as much as 2%. Now they're in the green, though it looks like they're pairing that modest gain. This is all after Bloomberg News reported that during a surprise probe this month by the European Union of electric vehicles coming into Europe from China, Tesla came up in their investigation. Basically, this investigation is looking into whether the electric vehicle industry is receiving unfair subsidies as it exports from China to the EU. Tesla started exporting its Model 3 sedans built in its Shanghai factory in late 2020, less than a year after starting production in that first overseas plant. And by July 2021, the company was referring to the facility as its primary vehicle export hub. Earlier the stock was down on the news. Now it's seeing a little bit of a rebound, and it had a rough last week, snapped a 4-day losing streak yesterday.
Interesting. So Tesla's,
built a ton of cars in Shanghai,
right?
Built a ton of cars in Shanghai. The Chinese have been handing out subsidies left, right, and center for EV car makers, including Tesla, and they're exporting a lot of those vehicles that they make. Tesla is, but also other Chinese electric car makers, to Europe.
What's the Chinese EV company? Is there one big one?
There are like 100.
Okay.
But BYD is one that's a big concern, global competitor.
How's the quality for those?
Well, I have never been in one.
Okay. The reputation?
But the reputation is obviously bad.
Okay.
For products made in China. However, I've heard that the quality is increasing to a competitive threat.
Kind of like the Korean automakers when it first came, quality wasn't good, but now the Kia stuff is
fantastic.
Awesome. Yeah.
Yeah. High quality vehicles out of Korea.
Yep.
So yeah, that's the concern. But look, we already get a ton of auto parts out of China. Right. So people are angry that these Teslas are being assembled in China. And shipped out to the EU. But if you ship all the parts out of China and then assemble them in Wolfsburg, nobody would know the difference.
Wolfsburg. Okay. What else you got there, Alex?
Yeah, more EV car maker news going on.
Good.
Ford is another mover today.
You know your audience, don't you?
I do. I obviously am the car expert here. Ford is another mover today. Shares were down about 0.8% last time I looked. The company was blasted today by the United Auto Workers Union for stopping construction on a $3.5 billion battery plant in Michigan. That was following scrutiny by Republican lawmakers of its ties to a Chinese battery maker. And this proposed plan near Marshall, Michigan, was expected to employ 2,500 workers and produce enough batteries to power 400,000 electric vehicles this year. But Ford's decision earlier this Monday puts the facility and jobs into limbo. This also comes, of course, against the backdrop of an ongoing strike by the UAW. The union said Monday that talks with Ford were very active, more so than General Motors or Stellantis, but this is a setback for them.
Is this a permanent idling of this construction of this plant or temporary? Do we know?
It seems temporary for now, but I guess we'll see what happens.
Part of the negotiating, maybe.
There's already been so much drama around this plant, right?
Is it?
Yeah, because everyone's angry that the Americans are cooperating with the Chinese, but I thought that was done, and now it's back, and the unions were angry about EVs, but now they're angry that this battery plant has been shut down. And I mean, what a mess. Yeah. What a huge mess in Detroit. It'll be so fascinating to see President Biden there today.
Walk in the picket line, and then Trump tomorrow.
Will he be walking in the picket line? Is he going to hold a sign? Yep. Is he going to chant? Or is he just going to go there to be there and not really participate? I think that would be a bad look. Trump tomorrow will be interesting as well, because Sean Fain has said, dude, you're exactly the kind of person that we're all against. You're like the poster child for what we don't like.
Rich billionaires?
Yeah.
Okay, I get it. All right. I guess rich billionaires kind of overkill there. DraftKings, what's happening with the sports business?
Yeah, so DraftKings is having a better day than Ford. Shares are up more than 3.5%. That's following an upgrade from JP Morgan. Analysts there moved up the stock to overweight from neutral. They cited sluggish price action since late July. Its shares slid 16% from a peak July 28th through Monday's close. It also cited competitive advantages over new entrants in the industry, including Penn's ESPN Bet. So good day for DraftKings there following that upgrade.
Yeah, up 3.6%. Stock's up 150% year to date. Are you a
dude? I've always said, if you want to get into a new business, find something that's addictive. Yep. That's always a good business, at least for a while. And on the one hand, you've got something like cigarettes, which as a society we've kind of fought back against, right?
Right.
Gambling, I don't understand why, but we're all for this now. We're like, you know what? Yes. Let's bring it back. Let's bring in online gambling.
Put it in the palm of your hand, basically, and anybody can bet on anything out there, and it's just crazy growth business.
Is that regressive, though? Is it kind of like a tax on the poor? I mean, go to states with big lottery operations and look in line. See who's wasting their hard-earned, the rest of their wages on lottery tickets.
Yep, I got stories about that.
It's not pretty.
Alex Semenova, thank you so much. We appreciate that. Alex Semenova, Bloomberg News, bringing us kind of an update on some of the news, some of the stocks moving this market. All right, Matt, we've been talking about this strike against the auto workers that doesn't appear like they're making much headway. One of the questions I have is, how long can these auto companies go with this strike from a financial perspective? Joe Levington joins us. He's the director of credit research for Bloomberg Intelligence. He covers the auto companies from the credit perspective. He joins us live here in a Bloomberg Interactive Broker studio. So, Joel, how are their balance sheets? How strong are these auto companies from a financial perspective? Because at some point, the strike's really going to hurt them financially, potentially.
Oh, 100%, Paul. Eventually they all have to get to a table and have to come to an agreement because everybody needs them to make money, right?
Well, they only have to have more money than the UAW.
Exactly.
So how does their balance sheet look compared to that of the United Auto Workers Union?
They're significantly stronger than the UAW.
Okay.
Combined, Ford and GM have about $90 billion of liquidity. Stellantis, I think, has about $70 billion of liquidity.
So liquidity for you is like cash on the balance sheet plus some bank loan lines that they can draw down on. So if I need cash, how much do I really have? And they've got like 90 billion, you're saying.
That's what I'm saying.
Okay.
And Stellantis has like another 70. So you're talking about $160 billion of firepower.
And the UAW has
$825 million of cash.
Oops.
That's what I'm trying to say.
Yeah.
I mean, if you were on the DraftKings app, you'd probably vote heavily that the autos can, last a lot longer than the UAW can.
And they haven't even really struck where it hurts, right? They hit them at a Bronco plant. That's bad, because there's already a long line of waiting for Bronco. Oh, they're awesome. They hit the Colorado, and I know, Mark Royce loves those mid-sized pickup trucks. Actually, I drove one, and I was really impressed with the turbocharged inline-4 engine.
Because you're an inline-6 guy.
I like an inline-6.
Sure.
I like a
Who
V8,
doesn't?
but this small engine I thought was super punchy, had a lot of torque. Anyway, they hit them, the Wranglers, high margin vehicle, but they haven't hit them on the truck lines, which is where it hurts, right? They haven't struck where they make the F-150. They haven't struck where they make the Tahoe and the Suburban. And that would be pretty hardcore if they did that.
It would be, but it goes both ways because the more people you put out of the plants, it also means the more they're draining down that $825 million, right? Because they're paying them while they're the UAW is paying their their clients while they're while they're on strike. But I agree with you. If you look back to times like the pandemic, right? The pandemic, really what you saw was about a $10 billion swing in cash flow over a couple of quarters. If you're talking about a Ford or a GM. So you could kind of get into that range, like if this protracts into, like a 5, 6, 7 week kind of event. But we're not there yet. And I think, while you have this time, both sides are going to haggle out for each percentage increase in salary that they can get.
How are the bonds? How have they been trading?
Bonds really haven't moved all that much because the raters have been done actually a very nice job of being very public about how they don't expect this to be impactful and how they've built in somewhere between 5 and 8 weeks of flexibility. So now that we're just getting towards the low end of that range, there's still plenty of room in terms of how they're thinking about ratings.
So we came out of so GM and Stellantis, they did go bankrupt during the great financial crisis.
Chrysler is really what you're talking about, right? Stellantis is essentially a French company that bought the Italian company that bought Chrysler for like $1.
It's a mix of Peugeot, Fiat, and Chrysler coming together.
But I'm going to guess where you were going with this. So we talk a lot about the fact that the unions took a crappy deal in order to help support the automakers post-financial crisis. What we don't talk too much about is that the unions had a much greedier deal that kind of pushed these automakers into bankruptcy during the financial crisis, right?
Yeah, we're still talking about, I guess Mary Barrow is out there saying that we made an offer worth $115,000 a UAW worker that was rejected. So whether you view that
that's their final pay, $115,000?
Right, that's your take-home pay. So whether you are, depending on what side of the coin you're on, whether you think that's good or bad, it doesn't sound particularly horrible to me in any way for a unionized manufacturing facility. But
well, I'm just dividing. So Mary gets about $25 million. So divided by 115. So she still gets 217 times more than that.
Yeah.
And she works hard, I'm sure, and she's steered the company through some tough times, but she's had their help.
Yes, and that's what I say. They eventually have to come together because they both need each other, right? If you're going to make money, you have to have workers, and if workers want to have a salary, that they have to have a profitable company behind them.
Now, they don't just want a salary, right? Mary has a defined benefits pension plan.
Yes.
Are the workers going to get that too?
Well, Ford seems to have caved a little bit on that front, Matt. That's a really difficult front for others to go into because if you think about GM, their OPEBs blew up to like $70 billion before they went bankrupt. I'm sorry, Paul. There are other pension liabilities that are on their balance sheet. That's really what drove them into bankruptcy to begin with, was to get rid of those liabilities. So to start bringing them back in, I think would be a really difficult thing and probably one of the bigger challenges on the GM side. whereas Ford, which didn't go into bankruptcy, seems more open to working with the union in that aspect.
So if I'm a creditor to, if I'm a bondholder of the big three auto companies, do I have a threshold where I don't want to see them have an increase more than 25%, 30%, or do I just not really care? I just want to get a deal done.
The pay part probably doesn't matter, right? You care about the pension.
I think you care about the pension first. When it comes to pay, when you're talking about these increases between 20 and 40% are kind of, like where people are targeting. Even if you think about 40%, it's 40% of 4% of your total cost, of your total bill. And that's before there's any cost benefits that the company may get. And that's before you think about pricing.
So labor's only 4% of their cost structure?
It's only 4%.
So
it's
what's a big deal?
Well, that's what two guys from Summit might say.
Yes.
But why don't you just call it 30 or 35%, have a drink and move on with life. And then you'd be fine, because really you're talking about a percentage point or two on your price side, or figuring out some cost benefits on the way, and then you can move on with life.
Yeah, but pensions are much more expensive.
Yes.
They also want a 4-day work week, which means you got to hire a whole bunch of other people and pay more health care benefits to those men and women. Plus, they want to know which products are coming. So, for example, Dodge doesn't have anything coming next year, and they're going to cancel a couple of their offerings. Chrysler only has the Pacifica minivan and nothing else.
Right. It's a good thing that the UAW is not at Bloomberg, because we love a 7-day work week here. I don't know what a 4-day work week would actually look like. It makes no sense to me.
I'm a fan of a 4-hour work week, frankly.
But clearly that's not going to happen with the auto workers. That's just thrown out as a starting point. But yeah, you're totally right. It's the full package, and it's really the benefits side that I think is more of the sticking point for a GM or a Stellantis.
So how do you think this plays out, having listened to both sides and all three companies?
Yeah, I mean, I think, Paul, we probably wind up somewhere that two Summit guys could figure it out over a cocktail, is that it'll probably be somewhere in the 30% range of a salary increase. You're going to have your 40-hour work week. Maybe there's some marginal benefit that they give back on pensions, and that's about where it'll wind up. And the reason that it's not that relevant to a credit person is because when you think about that increase, you're talking about 30 or 40 basis points of margin. It's really not that big a deal for the autos and their outlooks for the long term.
All right, we'll see what kind of deal they can get done. The president heading out to Detroit today, former President Trump heading out there tomorrow, so I'm sure that's going to be a huge help for having those folks out there. But it seems like it's just kind of some bare knuckles negotiation like we've typically seen between the auto companies and their union workers. Joe Levington, he's a director of credit research for Bloomberg Intelligence. No 4-day work week for this guy, and he's also in the Bloomberg Interactive Broker Studio, so you get extra points there. S&P 500 here off about 1%. We've been holding that decline for pretty much most of the morning. Same thing for the NASDAQ, off 1.2%. This is Bloomberg. Let's get some, right now, what are we going to do? We're going to get company news with Lisa Mateo. Let's do that.
You got it, Paul. Shares of DraftKings are higher after JP Morgan upgraded the sports betting platform to overweight from neutral. More from Bloomberg's Katie Greifeld.
Analyst Joseph Greff saying that basically buy into the stock's recent weakness. If you look from late July into yesterday's close, DraftKings had been down about 16%. But the sports betting industry overall is attractive right now. The industry as a whole is cutting its expenses, and specific to DraftKings has a strong moat in that product, scale, and brand. You add that all together, and that should allow DraftKings to successfully fend off some of its competitors.
DraftKings right now up about 3%. The Federal Communications Commission wants to reinstate net neutrality rules governing broadband providers now that Democrats have gained control of the panel. Bloomberg's Gina Cervetti says not everyone's happy about it.
High-speed internet providers like AT&T, Verizon, and Comcast are likely to strongly oppose any revival of the regulations. They argue that companies have not engaged in the behavior that the rules aim to prevent. That includes blocking and throttling internet content.
AT&T right now down about 0.5%. Verizon down a fraction. Comcast down about 0.5% as well. And Apple's services chief will testify in Washington today to defend having Google's search engine as a default on the iPhone. The company says it's the best choice for consumers, but the government says it hurts competition. Google pays Apple billions of dollars for the top position on its devices. Shares right now are down about 2%. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm Amy Morris with your Bloomberg Business Flash. The S&P 500 hit a 3-month low today. Consumer confidence in the economy is waning. Investors also factoring in a protracted period of high interest rates. We check the markets for you all day long here on Bloomberg Radio. The Dow was down 0.8% or 289 points. S&P 500 down more than 1% or 48 points, and NASDAQ down 1.2% or 159 points. The 10-year yield at 4.55%, the 2-year yield at 5.14%. NYMEX crude oil trading at $90.38 a barrel. That's a gain of 71 cents or 0.8%. Brent crude up 0.6% or 54 cents, now trading at $93.82 a barrel. COMEX gold at $1,921 an ounce. That's a drop of $15.30. The euro at 1.0576 against the dollar. The British pound at 1.2163 and the yen at 148.90. And that is your Bloomberg Business Flash. Paul and Matt.
All right, Amy Morris, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Definitely some concerns out there in the credit markets, but one area of a positive sign. We saw Standard & Poor's Global Ratings on Wednesday upgraded the government of Jamaica's long-term foreign and local currency issuer default rating from B+ to BB- with a stable outlook. It is the best credit rating that Jamaica has received from S&P since it started rating the country's sovereign debt in 1999. Some good news there. We're going to break that down with Senator Alban Hill, Minister of Industry, Investment, and Commerce, member of the Senate of the Government of Jamaica, joining us live here in our Bloomberg Interactive Broker Studio. Minister, welcome to Bloomberg. What drove the increase in the rating outlook from your ratings issuer for Jamaica?
If I could put two words, it's disciplined management. We took over in 2016, the Andrew Holness administration took over. We made a commitment to the IMF at the time that we would continue to make sure we become fiscally disciplined. Right through that period of time, we moved our debt down from the high, as you might recall, at 147 when we took over, must have been in the 135 or thereabouts, and move it down to where we are today at 77. And going in the direction of 60, we had planned to get there by 2016. The pandemic interrupted. Right. We moved it to 2018, but we might get there before 2018. And all through that, we've gone through the pandemic, spent 100 billion Jamaican dollars we didn't plan to spend, haven't borrowed any money, and we haven't raised taxes in 7 years. So that kind of fiscal discipline, the rating agencies have been watching it, and the best rating we've ever had in 24 years of S&P, we've just had the rating upgrade. And of course, we're not happy with that. We want to continue to make sure that gets to investment grade as quickly as we can.
So what are the industries that are driving this or supporting this growth? I have been going to Jamaica my whole life. We go to Silver Sands and Trelawney, and if I get a good bonus, then I'll spend a couple of days over at Rose Hall. It's a little pricey, but so tourism obviously is I would guess one of the main industries. What else is pushing this? Because Jamaica is not an offshore economy. This isn't somewhere where people go to hide money, or to start crypto businesses.
No, that's not what we do. Yeah. What happened is when tourism took a dip, and somebody who you've had here at Bloomberg many times, Ed Bartlett, found all kinds of innovative ways to help us open back tourism as quickly as we can. So that didn't stay down too long, and we're now back this summer, well past what we were in 2019 before the pandemic. But through the pandemic, we had the BPO, the business processing outsourcing business, the knowledge outsourcing business, and that grew by 20% per year in the last 4 years. So we quickly moved to work from home, made the adjustments because under the BPO arrangement and OECD watching, you have to make sure you follow certain basic rules. We got those fixed with the Minister of Finance and through myself. I was then in the Ministry of Economic Growth, which is the Prime Minister's ministry, worked it out, got it to work, and it kept on growing and it keeps on growing. But we also are looking at growing our exports because we have had, just like we had a long period of bad debt situation, we've had an even longer period of negative trade balances, and we're now grappling our hands around that as we've done with debt and that's one of my main focus. Why I'm here with 30 businesses to look at new markets and develop new markets, because you cannot be an exporting business and stay in your office.
Right.
So I take them with me. I took them here, took them to Atlanta. I'm going to London from here to make sure we develop the markets that we have and then wider field.
What are some of those markets that you'd like to develop, or some of those products or services that you'd like to develop?
For instance, you know Goya very well. We have something called Aki. Matthew would have had Aki for breakfast in Jamaica.
With my eggs,
okay, with your eggs. Looks like eggs. So we know, Goya said to one of our importers in Florida recently, we want 20 40-foot containers. They could only give them one. They want something we have callaloo, which is like spinach. They want breadfruit, which is we make into flour, and it's gluten-free, which people want. We want containers of that. So we have markets. While I'm looking for new markets, what I'm looking for as well, the Ministry of Industry, investment is the second part, and commerce. I'm looking for investment to fit those markets. Come in, help us grow our agriculture, process it, and make sure we have the markets for you. Come invest. So that's part of the message I bring as well.
What about cannabis? We talk about the cannabis business here a lot. Obviously, the legalization across, for recreational use, 23 states in the U.S. has grown the market, the legal market, considerably here. Can that be an export from a country that's, in a way, famous for Bob Marley and that sort of product?
We have exported to places like Australia and Germany, but you probably need to get to 38 states, at which point you can change the constitution, because it's a Schedule 1 drug, and until the feds change it, you can't do interstate banking. So you can do all you want in Colorado, but you can't ship it to California. So until that changes, as a Schedule 1 drug, we have to abide by certain international rules that we've signed in treaties. So we can't just export it willy-nilly, and we can't export to the United States, or even use your airspace to export it.
What is the political climate like in Kingston? I mean, we have here a very partisan, very divided political system, which is driving Moody's to threaten a downgrade. We've already had downgrades at Fitch and S&P. So what advice can you give to the U.S. government, post-upgrade, to try and get along and govern correctly?
Why don't I tell you what we've done? We have made sure that we focus on the fiscal part, because I noticed why Moody's is threatening to downgrade. The same reason S&P did in 2011. It's from what I've read, it's the fractiousness over the government closing down. Well, we can't say anything about that, and you have the privilege of having the reserve currency in the world. So you're in a very particularly privileged position. But what we have done in Jamaica is, if we didn't get, I remember when the IMF came in 2013, I was in that meeting, called at the University of West Indies by Oliver Clark, who I know you know.
Yes, from Silver Sands.
From Silver Sands. Oliver called that meeting. I remember the Governor Brian Winter at the time saying, we cannot get our currency and our inflation under check unless the government gets its fiscal house in order. You never hear or know, we've made the Bank of Jamaica independent. You never hear the government talk, the governor of the central bank talking about the fiscal position of the government, because we've put it under control. And until you get that done, then the rating agents will have that discussion. But frankly, your discussion is quite different, because you're the reserve, you hold the reserve currency and the biggest military in the world.
Minister, talk to us about the economy today in Jamaica. What's it like for the average Jamaican today?
The average Jamaican, first of all, just recently, the most recent figure we had for unemployment is 4.5%. It's the lowest in the history of taking numbers in Jamaica. So we have a historical low in unemployment. In the emerging market, 4.5% is near to full employment. So what's happening? People in the knowledge outsourcing business, the hospitality business, the tourism business, saying, and the construction business, we want people. 70 to 80% of our university graduates are women. We have 300 or 400,000 young people on the street who tend to get into gangs. They're men, primarily men, because they're the ones who weren't graduating. So now we're saying we have Hard Trust NTA. We're investing money to take them off the street, put them in a training center for months, pay them a stipend. A part of the stipend we use to open a bank account. We give them a national ID. We give them a passport, driver's license, so they become part of the citizenship. We give them the discipline, certify them, so they could work in Jamaica, the United States, or Saudi Arabia, and put them back in the workforce. So we're expanding the workforce in this vicinity, but with apprenticeship with skills.
All right. That's good news. That's a good story. The Standard & Poor's certainly think it's a good story. Jamaica upgraded its credit rating. Senator Alban Hill, he's a Minister of Industry, Investment and Commerce. He's also a member of the Senate in the government of Jamaica. We appreciate getting a few minutes of your time.
Great to have you here. Thanks so much for joining us.
With our news in New York, here's Michael Barr.
Thank you very much, Paul and Matt. President Biden's son, Hunter, has reportedly filed a civil lawsuit against President Trump's former lawyer, Rudy Giuliani. Hunter Biden claims they caused total annihilation of his digital privacy through their alleged efforts to hack his devices. It comes as House Republicans are preparing for a hearing this week that will focus on President Biden and legal questions about his involvement in his son's business affairs. Bloomberg's Nancy Lyons has more.
A spokesman for the House Oversight Committee says Thursday's hearing will focus on, quote, the president's involvement in corruption and abuse of public office, end quote. Morning Consult's Eli Yoakley tells Bloomberg Sound On Democrats seem resigned to what they call a political stunt.
A good number of Democrats think it's okay to open this investigation. I think some of that might be, just do it to clear the air.
President Biden's team has tapped a bench of Democratic veterans of Donald Trump's impeachments to expose what they say is political disarray in the Republican Party. In Washington, Nancy Lyons, Bloomberg Radio.
With just days to go before government shutdown, Congress returns to work in crisis mode. House Speaker Kevin McCarthy faces an insurgency from hard-right Republicans wanting to slash spending. Meanwhile, Senate Republicans and Democrats are nearing a deal on a short-term spending measure. President Biden is joining striking auto workers on the picket line in the Detroit area today. Tomorrow, former President Trump will speak to auto workers also in Michigan. This just crossing, Senator Cory Booker says his fellow New Jersey Democrat Robert Menendez should resign following an indictment. Booker, in a statement, says that the details of the allegations have shaken people to the core. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts over 120 countries. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm Amy Morris with your Bloomberg Business Flash. JP Morgan Chase reached settlements with former executive Jess Staley and the U.S. Virgin Islands over ties to Jeffrey Epstein. Elliot Stein is a senior analyst at Bloomberg Intelligence.
This has been a sordid saga ever since Epstein was arrested, and then both banks settled with the victims previously. And now we have this settlement, which should put an end to at least, the litigation against the banks.
Bloomberg's Elliot Stein. Shares of JP Morgan now down more than 1%. We check the markets for you all day long here on Bloomberg Radio. The Dow is down 1%, or 326 points, now at 33,682. S&P 500 down 1.2%, or more than 50 points, now at 42,086.80. And NASDAQ down 1.2%, or 158 points, rather, at 13,113. The 10-year Treasury at 4.53%, two-year yield at 5.13%, and NYMEX crude oil trading at $90.33 a barrel. That's a gain of 65 cents, or 0.7%. Brent crude up 0.5%, or 46 cents, now trading at $93.70 a barrel. And COMEX gold at $1,923.20 an ounce. I'm Amy Morris. That's your Bloomberg Business Flash. Paul and Matt.
All right, Amy Morris, thank you so much. We appreciate that. Paul Sweeney, Matt Miller. We are live here in a Bloomberg Interactive Broker studio. We're doing that streaming thing on YouTube, so you can head over to youtube.com and search Bloomberg Radio. We're everywhere. When I joined Wall Street in mid-'80s, Matt, you had to do a stint in Tokyo. I mean, even before London. That's how big Japan was as a growth area and as an area of investment. And then, man, we went through like a generation where there was nothing going on in Japan. And now I'm starting to hear a lot more about Japan. Like even, Warren Buffett is talking up Japan and things like that. So when Matt Winkler came out with his column today, I say, we got to get this guy in here. Matt Winkler, he's a founder of Bloomberg News. He's the editor-in-chief emeritus of Bloomberg News. He joins us here in our Bloomberg Interactive Brokers studio. He's got a great column out talking about Japan. When did Japan become like a growth story again?
I was surprised, actually, to read this. So
yeah.
They're the leader in terms of the group of seven in life expectancy. I knew about that, but per capita growth, that's pretty surprising.
Yes, it is, when you consider that they had a record decline in population just last year, and that has been the biggest obstacle for Japan, Inc., if you will, going back decades now, and that trend is continuing. Great to be with you. Having said all of that, to answer your question directly, going back 10 years, you could say, has been maybe the turning point. And the reason why it's been the turning point is the Japan that we know today is a very different Japan than the one of 1990. It's much more diverse. Its economy is actually much more dynamic. This is a Japan that continues to invest in itself. While every major city, if you like, on the planet has got some kind of housing problem, accommodating people, Japan doesn't. Doesn't have a youth unemployment problem. The big shift came, if you like, with Abe, the former prime minister, unfortunately assassinated last year, and what is known as Abenomics. And Abenomics really was about creating opportunities in the workforce, and actually he can thank someone who was in her own right very much in the vanguard in the 90s. Kathy Matsui was the first woman partner of Goldman Sachs Japan, and she coined the term womenomics and said that if you put women in the workforce, and at the time they were 57-something%, and you get women working in Japan, you will dramatically increase GDP. And she became very friendly with the Abes. And next thing you know, Abenomics has been all about creating a much more dynamic workforce. So you could say since 2013-14, Japan Inc. has changed. And you're right, per capita income growth for Japan in the 10-year period to the present outperforms every G7 country.
Which is even more interesting because they have a shrinking population.
Correct.
Right? And this is more problematic than it is beneficial. You would think, okay, the pie or the people eating the pie, if they're shrinking, then the piece each person is getting is bigger. But really, you need to grow the population if you want to grow GDP, right?
Yeah, and Japan is a wealthy country. And like a lot of wealthy countries, including this one, it has all kinds of issues. Having said that, money managers have noticed, and you mentioned one in particular, but money managers have noticed that Japan, on a relative value basis, is still very cheap compared to other G7 markets. And so one fund in particular from T. Rowe Price has been outperforming every investor in Japan with superlative returns, over the past 3 years because the relative value of Japan is still very attractive to investors. For example, Toyota, as we speak, earlier this month was an all-time high, and that's just an indication of the company's performance recently.
They have had better dollar-denominated stock returns than any other market in at least the developed world. They have had an incredible shrinking yen. I mean, maybe you could say the dollar has been on a run in terms of its strength. But what does that do to the economy when you see 140, 145, 150 yen to the dollar?
Well, the big issue is that at some point, and here's something that really needs to be mentioned, Japan was in a deflationary era, if you like, since the 1990s until the COVID period. And for the first time in decades, Japan has now got some inflation. We're all very nervous and anxious about inflation, and there's good reason to be so. Having said that, if you ask CEOs which would they rather deal with, inflation or deflation, they're going to take much more risk with inflation. And so there's a, if you like, an inflection point, turning point right now in corporate Japan. And that's a good sign. But one consequence of that, you mentioned the weakening yen, is that at some point the Bank of Japan is going to have to negotiate much higher interest rates. And that's something that, we haven't seen in a very long time with Japan. So the weakening yen is an indication that that's coming.
Is there any one industry or group of industries that's fueling, I guess, the improved economy in Japan?
Well, interestingly enough, if you look at all the exporters, they're all doing well.
Yeah.
And that is just an indication that, as I said, the relative value of these companies is finally getting noticed.
So how did the COVID impact Japan? Because I think of Japan as it's an island or an island nation. I mean, it's just not, I kind of think it was a little bit more segregated, if you will, kind of down in the Pacific. I don't know if they were hit as bad.
So, like every major country, Japan dealt with COVID, but it dealt with it actually quite well. And with the rebound from COVID, there's been a big increase in tourism. One of my favorite economists who used to write for Bloomberg Opinion, Noah Smith, has actually called Tokyo the new Paris. And he is not alone in identifying Tokyo as one of the greatest cities in the world, maybe the greatest.
It's also, I imagine that our disintegrating relationship with China and reshoring has had an effect there, because I know we're pushing out to Vietnam, to India, to the Philippines, to Saudi as well. So
yeah, so that's absolutely right. And one consequence of that is that Japan, corporate Japan, the government of Japan, and the U.S. are all behind a startup company that will be building the highest end chips for the first time. Cairo. And so that's a consequence of this new Cold War that you're speaking of.
Yep. All right, Matt, thanks so much for joining us. As always, Matt Winkler, he's editor-in-chief emeritus, founder of Bloomberg News. Check out his column. You can go
He hired me.
He did? Well, you can't.
Had to talk to
you
Matt.
can't get them all right. You can't get them all right. This is Bloomberg. Let's get some company news right now. Elisa Mateo.
We all love you, Matt. Good morning, guys. U.S. beauty company Coty has applied to dual list in Paris. Shares are lower right now. They're down about 2%. Bloomberg's Kriti Gupta spoke to Daybreak from London.
This is the makeup company that Kylie Jenner once had a stake in. Here's why it's important. It looks like they are actually going to be debuting some more shares, 33 million to be exact, in the Paris listings. And basically what this tells you is diluting the overall company, even though they're bringing this global offering. The idea here is simply being that they're going to bring the luxury story, keep it in Paris, while also being dual listed in New York.
Now to hear that full conversation, check out the Bloomberg Daybreak podcast. It's available wherever you get your podcasts. The European Union's investigation into electric vehicle imports from China isn't focused just on Chinese automakers. Tesla's in the spotlight. Bloomberg Global Auto editor Craig Trudell explains.
This is a company that opened a plant in Germany in March of last year, but it continues to supplement the output from that plant with production from a lower cost facility in Shanghai that has an awful lot of capacity to make quite a few electric vehicles. And Tesla has been taking advantage of that and shipping quite a lot of EVs into the EU.
Tesla right now up just a fraction. And some holiday hiring news. UPS will bring on more than 100,000 full and part-time seasonal workers this year. And Dick's Sporting Goods plans to hire 8,600. Its National Signing Day kicks off October 3rd. UPS shares right now down just about 0.5%. Dick's Sporting Goods up a fraction. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, we got Michael Barr here with world and national news in New York City. Let's
get it. Thank you very much, Paul and Matt. Another Democrat has called for Senator Bob Menendez to resign after his indictment, and this time it's from his fellow New Jersey senator. Cory Booker, in a statement, says the details of the allegations against Senator Menendez are of such a nature that the faith and trust of New Jerseyans, as well as those he must work with in order to be effective, have been shaken to the core. Other Democratic senators have called for Menendez to step down, including Sherrod Brown of Ohio and John Fetterman of Pennsylvania. Menendez is accused of corruption and bribery. There aren't many days left for lawmakers to avoid a government shutdown, and if no deal is reached, millions of government employees could lose their pay. House Speaker Kevin McCarthy has been trying to unite Republicans, but several far-right members of his caucus aren't budging to reach a deal. This woman has been working at the cafeteria to the Library of Congress for over 40 years and was fighting back tears.
A lot out here, just like me. Living paycheck to paycheck and can't afford to do anything, you know, and then the government shut down. And like I say, the government will go back and they're going to get paid. We're not going to get anything.
She wouldn't get any back pay because she is a government contractor. It is day 12 of the UAW strike against the big three car companies. President Biden will be making history when he joins striking workers on the picket line in Wayne, Michigan. Tomorrow, former President Trump will visit the workers. Talks are inching closer as the UAW fights for a 40% wage increase and better benefits. A bipartisan proposal to open up the banking industry to the cannabis industry is making its way through Congress. Since marijuana is illegal at the federal level, the major credit card companies don't allow cannabis purchases with plastic. That's turned growers and dispensaries into cash-only operations. The measure would loosen the restrictions, giving the cannabis industry easier access to mainstream banks. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr. This is Bloomberg. Paul, Matt, John, you're here. We love you, man.
Not really, not officially yet.
Okay, all right.
Michael Barr, just to show you that we pay attention to your newscast, that one about the weed thing, that kind of got me. You can't use Matt, so I turned to Matt, our resident expert. You can't use a credit card or
You
a debit
can.
card?
You can. Most of the unlicensed dispensaries in the area, as well as the legal shops, you know, that have opened up in New York. They do accept credit cards, but they need to find workarounds. So what they have been doing until now is they treat it as a cash withdrawal. Let's say you buy, I don't know, $33 worth of marijuana products down at the Empire Cannabis Club, for example, on 17th and 8th. They'll say, okay, we charge you $35, and because they have to round it up to the nearest $5 increment as a cash withdrawal, and then they give you $2 back plus your gummies or weed or whatever you bought.
Interesting.
But I wonder how much longer that can last, and it's still problematic because there are, in most parts of the country, cash-only dispensaries where they end up with massive amounts, like stacks of Benjamins, right? And that's dangerous. You know?
Yeah, well, that's one of the things that they're talking about, because when you're all cash, now you're open for more crime, and that's just what you just said. So
Exactly. By the way, speaking of crime, I wanted to ask you guys who have grown up in New Jersey, is the Menendez, you know, the discovery of $500,000 in cash and gold bars in his house, did that come as a shock to you? Were you like, no, I can't believe?
Absolutely not. I mean, A, this guy's got a history of it personally. B, it's part and parcel to New Jersey, particularly North Jersey politics, would be my take.
And part of the reason, as somebody in the media, is that New Jersey does not have its own central core of media. You're stuck between two media capitals, New York and Philadelphia. And New Jersey, the coverage there is short shrift.
So that's why Trent, New Jersey, before cable TV, was the best TV market in the country, because you got all the Philly stations and all the New York stations. How about that?
Wow.
This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Gary Schilling, president of Gary Schilling and Company, get his thoughts on these markets and this.
He was the first ever market economist, chief economist at a bank. Before Gary, I think he started out as the chief economist at Mother Merrill.
Yes.
Before that, only
Don
bond
Reagan.
shops had, like Henry Kaufman, at Salomon Brothers. Stock equity shops, they didn't have economists.
All right, but we got him.
Yeah.
He's coming in. That's awesome. And so we got that coming up. Plus, Rohit Mehta, CEO at Horizons ETFs. We love talking about ETFs. Where is the money going today in the world of ETFs?
Flows.
Right now, let's go to John Tucker for a Bloomberg Business Flash.
All right, S&P 500, NASDAQ, even the Dow at this point, close to losing over 1%. Data in the driver's seat, you had consumer confidence stalling this month, purchases of new homes falling to a 5-month low, and who can afford a home? Prices in the U.S. rising to a record high over the summer. The threat of tight policy undoing some of the market's biggest gainers this year. You have Apple, Microsoft, Amazon, Alphabet were all dragging stocks. Advice for investors, meantime, from Russ Kostridge at BlackRock. He says now is the time to focus on quality.
We are back in an environment like 22, at least temporarily, where you're punished for high volatility, low quality assets. The market is rewarding consistency. And if you're an early growth stock, you're an EM stock, you're a small cap stock, you're getting penalized.
Right now, the S&P 500, 50 points lower. This is down 1.2%. We're at 42.86 on the index. Dow Jones Industrial Average, 308 points lower. That's down 0.9%, 33,699. The NASDAQ 100, 1.3% lower, down 193 points at 14,576. The two-year yield up 1 basis point is all right now, 5.14%. The 10-year is at 453, pretty much unchanged. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. I can say if you look at Gary's coffee table, you see this nice, beautiful little, I don't want to call it a cigar box, but it's a beautiful wooden box made by yours truly.
Tucker, look at you.
You made Gary Schilling a cigar box?
Such a nice guy.
Yes.
I didn't know you were so handy.
Well, I didn't say it was a good box. It's
All
nice,
right,
though.
John Tucker, thank you so much for that. We appreciate it. Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Brokers studio. We're streaming live as well on YouTube, so head over there and search Bloomberg Radio. 1.2% decline in the S&P 500, 1.3% on the NASDAQ. So lots of red on the screen here today. Let's see where the action is. We do that with Abigail Doolittle. She is the Bloomberg Markets reporter. Abigail, what do you got for us?
It's a pretty bearish day at this point. It sort of also feels like it's out of nowhere because yesterday we had that bullish reversal. Sometimes that kind of action could extend into another day. The bulls were probably certainly hoping that. But instead, we are basically at session lows. The S&P 500 down 5 out of the last 6 days. From the July top, we have the S&P 500 down more than 6%. And Matt, you really highlighted it to me yesterday on the open when you're filling in for John Farrow talking about stocks, that the Russell 2000 is down 11% from the peak. And interestingly, it's actually outperforming today, down just 0.6%. But it also is below its 200-day moving average, which is a fancy way of saying the near-term, medium-term, and long-term buyers are not stepping up for the riskier, growthier, small-cap stocks. Often you will see the large cap stocks follow at some point after. Years ago when I was working at Hugh Johnson Advisors, I didn't know Hugh that well at that point, but he was in August of 2007 basically pulling out some of his hair, really agitated. And the reason
He's pulled
was,
out a lot since then.
and the reason being was the models were telling him to sell small cap. So we as a firm had started selling small cap in client portfolios. That was August of 2007. So that was before the S&P 500 peak. It was before the NASDAQ 100 peak. And it was well before the real drama of 2008.
Yep.
But small cap tends to lead. So it's something to keep an eye.
Interesting.
I wonder what you think about there's Gary, and I'm going to ask him about this as well, Abby, but the Jamie Dimon call, seemingly out of nowhere, to get ready for 7% Fed funds rate.
It's not the first.
When I read that, I was shocked, though, and I was like, whoa, if Jamie Dimon is saying this, people are going to start talking about it. I see
Yes.
Ben Emmons from New Edge Wealth is writing about it today as well. That has to have spooked the markets to some extent.
I think you're probably right about that. And the interesting thing is this is not Jamie Dimon's first weigh-in on the Fed funds rate this year. At the beginning of this year, I don't know if it was January, February, could have even have been December.
He was saying 5.
He was saying 6.
6.
So when
okay.
when the 2-year yield was first going up toward 5%, he was talking about 6%, and then the yields on the banking crisis came back in, and that was kind of forgotten. But he's sort of ahead of the trajectory in terms of where yields go. So, and I would say if there's anybody who really has their pulse on the macro, the micro, he's probably one such
I find it
person.
interesting that Jamie's out with those kind of comments. David Solomon, the CEO of Goldman Sachs, is out calling out weaker economic growth.
And saying get ready for a slowdown.
My point would be, I would say my economists are forecasting a Fed fund rate of 7%. Because, now you got your CEO out there with a call that may or may not agree with what the House call is. I find that an odd dynamic.
Well, he's done that before, even beyond the 6% call, but with Bitcoin. He's bold. He is Jamie Dimon. He's probably one of the most credible people, in the country or the world on any topic, really. If he says something, that is
now I got to go redo my model.
He's the E.F. Hutton of our times.
Yes, exactly. Yep.
When he talks, people listen. Abigail, thanks so much for that. Abigail Doolittle talking to us about the market. We're seeing a big drop, no doubt, in equity indexes today, more than 1% on the S&P 500 and on the NASDAQ. We are seeing rates now come back and rise further. The 10-year is at 454, and that's the highest level that we've seen since 2007. We have one of the best people in the business to talk about this here in the studio. Gary Schilling from A. Gary Schilling and Company has darkened our door. And Gary, we've seen an incredible rise in rates over the last few weeks. What is going on here?
Well, I think there's a conviction that the Fed is not through tightening, and I don't think they are. They really are determined to get inflation back to 2% and to keep it there. And of course, they were very much behind the curve when they started early last year. They thought that the inflation spurt was simply reopening of the economy after the pandemic and the problems with supply chains.
Now, hang on a second. What have you got there? Is that like a candy bar wrapper? Or?
It's a Swedish fish.
All right, now put the Swedish fish down because we hear that crackling on the air. So what do you think about Jamie Dimon's warning? 7% may be just a number that he picked out of the air when he was talking in an interview to the Times of India. Who knows where he got that number? But we all thought that at the most, the Fed is going to like 5 3/4. And now all of a sudden, everyone's talking about 7.
Well, interestingly enough, we've done a lot of work over the years. We just updated on what we call a debt bomb. And that is the question of what is the rate at which the interest on the debt, which of course is part of the deficit, becomes so great that the whole thing grows geometrically and blows up. Now, the interest rate on the federal debt now is under 3% because a lot of it's short term. But of course, it rolls over in time at higher rates. So if we stay here, it could be a problem, although our numbers show that unless you got 8% on the federal debt.
The average 8, and we've never been there, right? Because I remember reading...
average maturity is only 6 years. So until you got to 8%, you probably didn't have a problem. But we've never had that problem. We've never had a debt bomb. The closest we had was 1992 when interest in relation to GDP was 3.1%, it's now 3%. It's basically the same. So we haven't been there. We're not Argentina, but you know, this is obviously a concern because if interest rates are up and stay up, of course, there's a lot of other things you worry about. I mean, you know, the economy, I don't think, could stand anything like 8% interest on the federal debt, because you'd be talking about double digits for everything else, and we haven't seen that since the Volcker era and the ensuing collapse.
Well, now there's a lot of things you've done in your career to become such a famous economist. Probably the biggest is you're a bond bull, and were for throughout the bond bull market, and you know, really made your name with those calls. How painful then has this drop in price, run up in yields been for you? And at what point do you say, okay, now it's time to buy again?
Yeah. Well, obviously, when you've had a long-term forecast, and you might recall, Matt, when I said in 1981 that we're entering the bond rally of a lifetime, the yield on the 30-year bond was 14.6%. It was a long time ago. Obviously, it came way down. Now it's rebounded with all other rates. I think we're getting close, because the economy simply cannot stand these kind of rates. We're close to, or maybe already in a recession. It's always up to the National Bureau of Economic Research to make that call. But I think that will do it. And of course, you get a recession, what happens? You get less demand for high quality credit. You get the safe haven of the treasuries. You get the Fed easing. But I think the Fed is going to be slow to ease, because they want to make sure that inflation is killed and killed dead. They really are. We're so far behind the curve on this. So I think this whole thing is going to get stretched out. But I don't think we're quite there yet where I won't go out. We in our portfolios we manage, we do have some long bond positions, but relatively small. We're not adding to them right yet.
Is there irrational investor exuberance back in this market?
Well, it sure is. I mean, if you look at example at the FANG index, growth stocks. Now, to the extent that their prices today are the discounted value of future earnings out 5 or 10 years, those things ought to be in the tank. Now, they've sold off a little bit lately, but I mean, they've rallied for most of the year. And of course, this is a big thorn in the side of the Fed, because they see investors really not believing them. They just don't really believe that they're serious, because if they did, you'd see a lot of things like this. You'd see stocks in general, and say the FANGs, the interest rate sensitive, housing already affected by interest rates, but investors in terms of securities, not yet convinced.
So you think, or I guess, do you think that there's really risk to the stock market in general?
Oh, yeah. Early last year, I said I thought we'd have a 30% decline peak to trough. We were down 25%. You got a rally. That means from here you need about a 30% decline. And yeah, I think there is big risk. I mean, you look at all the indicators. You look at the leading indicators. You look at the yield curve. You look at small business hiring intentions. It's just a whole host of factors. And boy, if this doesn't tell you recession and all that goes with it, including Fed ease, a lot easier, a lot lower rates, you got to throw out all the history books.
I would think so too. And you know, I have a laundry list of all of the headwinds and all the problems that consumers are facing, and you've got, along with that, this strike, which could be bad for the economy, and also inflation, government shutdown, which doesn't augur well. Student debt coming back, delinquencies on credit card debt and auto loans. Yeah. Every time I run this list by a bull, he'll say, hey, unemployment is at 3.8%. You know, as long as we have jobs, it's no big deal.
Well, one of the real issues here, Matt, is that employers spend so much time and energy hiring people that they're very reluctant to lay them off. It takes time to shift gears 180 degrees. But of course, as profits and sales weaken, that's what happens. They get layoffs. But this is one of the reasons I think this whole exercise is going to be stretched out. The other one is the Fed taking their good sweet time to shift to ease because they want to make sure that inflation is really.
But that could mean a deep recession, right? If we have, that could mean a very deep recession. If we have the kind of slowdown where, companies have been not wanting to fire people, but are all of a sudden then pushed to do it, and then the Fed doesn't want to come in and cut rates until the economy is really in trouble, that could mean a big, deep drop.
I think it means a long recession, but not necessarily deep. To get a really deep recession, you've got to have a major financial crisis. That's what happened with the dot-coms in the late 1990s, and of course that's what happened with the subprime mortgages.
The great financial crisis. I mean, looks like there could be the beginning of that happening in China right now. Does that
deep as opposed to long? Or you got to get a huge inventory correction.
Well, does the Chinese property problem worry you, or are we too insulated from that economy?
Not that much. I mean, our trade with China has atrophied. It does mean that China's internal growth is going to be weak. But you look at Xi, who basically is a president for life. He doesn't really care about the well-being of the average Chinese, only that it's good enough that the regime doesn't get tossed out. But they're in a different world. I mean, we look at it through Western eyes, where growth is good, but they don't look at it. Staying in power is good as far as they're concerned. So I don't think that China really cares. And of course, they got the property problem. They got overbuilt infrastructure. They got huge debts as a result of this, particularly at the provincial level. Well, I think China is basically going to be in its own sphere. Now, one thing that does come out of this is China's growing more slowly. It's the second largest economy in the world, and it's a stage of growth where it's more emphasis on goods than services. As economies mature, they shift to services, and when you're in goods, you need commodities. So I think that's weak in commodities. Obviously, is very differentiated. The stuff that goes into electric cars it's kind of in its own world. But you look at copper. Copper is my favorite. I like copper because there's no cartel on either the supply or demand side, and it goes into almost anything manufactured. I mean, again, full disclosure, we're short copper in portfolios we manage.
You're short copper?
Yes.
That's no bueno. Why are you short copper?
Well, because because that's a bet on global manufacturing weakness.
Yeah.
Plus the fact of the sake.
He is a bear.
I mean, you look at OPEC. You can have a great forecast on oil, and yet OPEC Plus comes out tomorrow and makes some announcement, and you're really in trouble.
All of a sudden, we're looking at $90, $100 barrels.
Yeah.
Gary, great having you in the studio. Thank you so much for coming in. Gary Schilling.
We just turn them on and we can just sit here and listen all day.
Yeah, well, I do that sometimes on the weekends.
On the weekends, okay, very good. All right, Gary, thanks so much for joining us. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. JP Morgan Chase has reached settlements with former executive Jess Staley and the U.S. Virgin Islands over ties to Jeffrey Epstein. The bank tentatively agreed to pay $75 million to the territory. More from Bloomberg's Shonali Bosick.
They said that the settlement does not involve admission of liability. However, the firm deeply regrets any association with this man and would never have continued doing business with him if it believed he was using the bank in any way to commit heinous crimes. That is according to JP Morgan. The fines in total, this lawsuit and a prior lawsuit that was almost $300 million in settlements, brings us closer to $400 million in total settlements. And that is not including any undisclosed sum that involves Jess Staley as well.
Now, shares of JP Morgan are down about 0.7%. And a big blow to Boeing as Airbus lands an offer from Air France. The carrier is purchasing 50 aircraft with an option to buy another 40. Bloomberg's Benedict Camel says it's the result of 7 months of intense negotiations.
The factors that played into this were range, for instance. That was an important factor that played into Airbus's hands. It was price. It was also something like, the availability of the plane, who was able to supply them sooner rather than the other one. So all these factors combined gave Airbus a leg up.
Right now, they are up about 0.5%. Boeing, though, down about 0.7%. And staffing shortages at pharmacies during peak vaccination time is pushing office workers to pitch in at its stores. The Wall Street Journal reports CVS is encouraging corporate employees to complete a 4 to 5 hour shift in the store once a week. CVS shares right now, they are lower. I'm Lisa.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News with this Bloomberg Business Flash. Let's start with the news on Amazon. The Federal Trade Commission suing Amazon. It's a long-anticipated antitrust case. It accuses the giant of monopolizing online marketplace services. Shares, they were down actually earlier. Right now, shares of Amazon among the most actively traded, down 2.9%. Yield on the benchmark 10-year Treasury note continues to stay around multi-year highs, even after falling 2 basis points to 451. And stocks across the board, they are lower right now, down about 1%, over 1% for the S&P 500, down 48 points, a decline of 1.1%. The NASDAQ 100, 181 points lower, that's down to 1.2%. The Dow right now, 303 points lower, that is down 0.9%. Some of the data in the driver's seat, the Conference Board September Consumer Confidence Survey falling to 103. That's actually a 4-month low. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio. Let's check in with our next guest right here, Tim Dewey, Chief U.S. Economist for SGH Macro Advisors. Tim, I'm not sure if you heard our last discussion. It was with Gary Schilling, and he was bearish, right, Matt?
Well, he is obviously, one of the most famous bears on Wall Street.
Exactly.
A lot of what he was saying reminded me a little bit of what I've heard from Jeremy Grantham as well, who is, obviously uber bearish. But I have to admit that I have that appeals to me because I see so many headwinds in this economy, Tim, and the exuberance that pushed us up to 4,500 on the S&P just doesn't make sense to me as the Fed's raising rates 500, 600 basis points. How do you see it?
I'm a little bit more optimistic than Gary Schilling. I'm not quite as bearish on the economy. I tend to be much more optimistic that the economy remains more resilient than people give it credit for, and that's a big reason here why stocks have performed better than I think anybody would have anticipated in this cycle. Given, as you said, the Fed raised rates over 500 basis basis points and is threatening, the possibility of even more. But I think that just really reflects that the economy is at a fundamental level different and stronger than people have really, I think, been willing to contemplate.
Than ever before in history, right? I mean, when's the last time the Fed was able to raise rates 5 or 6% without causing a recession?
It's a big shift, right? And so plenty of people pointed out too, indicators over the past year and a half that would all point to a recession, and so far, that recession just hasn't materialized. And again, it just, I think, speaks to a very different economic environment than we've been familiar with.
So, I mean, for better or worse, Tim, on my personal agenda, I've taken recession off the table several months ago, but was I a little premature there? Is that still really potentially in the cards here?
Well, so eventually, right? I mean, this is the stop clock argument. Right. Is there's always going to be a recession sooner or later. Yeah. But I think you were wise to take it off the table several months ago, because clearly, I think the predictions that we would have a recession by this time, just haven't materialized. And I don't really see one coming, anytime soon. I think there's still some momentum under this economy, and that momentum's not going to fade very quickly. So I really, I don't have a recession in the forecast because, it's such an idiosyncratic event, and that's what keeps tripping people up. Is that every recession is a little bit different. The indicators that lead you into that recession are a little bit different every time. So, we really, I think, don't have a lot of visibility on when another recession is going to occur.
And it's a big and diverse economy. Who is it? Ed Yardeni has said that he thinks we're in kind of a rolling recession where different pockets of the economy are hit at different times. You're not just the chief economist at SGH Macro Advisors. You are an actual doctor in economics. I mean, you have a PhD and teach courses on this and, help to guide the economy of the state of Oregon as far as I understand it. What do you think of that idea, rolling recession? Some states are going to have problems. Some industries are going to have recessions, whereas, we don't see everyone having a uniform recession. Doesn't that make sense?
Oh, it makes a lot of sense. I mean, we sort of forgot. I mean, during the immediate aftermath of the pandemic, when everything was booming, right? Everybody was doing well. That's really not the norm, right? If you have a slower economy, it's still solid, but slower economy, you have sectors that are up versus down. And that's just part of the natural give and take, I think, of the economy. You can't expect everything's going to be cruising along at a high speed. And of course, that makes it more difficult to assess, if you're going to fall into a recession or not, because again, one industry sliding, you say this industry always slid during or prior to a recession, then you turn around and you find another industry that had always slid prior to a recession, but now is gaining traction, right? And so you kind of say, well, wait a second, what's going on here? And what's going on here is that you don't have a economy-wide shock that is really driving firms to cut investment and cut employment in a very synchronized way. And until you can get that kind of shock, that kind of momentum, I think it's really hard to create a recession in the economy.
That's kind of where I want to go. This labor market, Tim, just kind of fascinates me. I've heard the term hoarding of employees, and I've never heard that before. What do you make of a 3.7% unemployment rate here in this economy? Certainly it was during the case of the pandemic that labor was so hard to get, you didn't want to let it go. I think that, firms, if they had the sort of economic conditions that drove the need for layoffs, they would react quickly. So the labor hoarding story only takes you so far. And remember last winter, around the turn of the year, we saw, so lots of layoffs in the tech industry. So even though that had been an industry that had struggled immensely to hold on to labor during the pandemic, once it was ready to shed labor, it shed labor. Now
that story, I think, is past us already. So for me, again, when I look at what happens to the unemployment rate typically in a cycle, it falls to some level like this, say 3.5 to 4%, somewhere in that range, and it just sort of hangs out there until you can get again that massive negative shock that really pushes you into another direction. So.
Tim, I just want to jump in because we are looking at pictures of President Biden on the tarmac with UAW President Shawn Fain and some other union members. And while we're speaking about labor, I might as well bring up this because I think we've seen a really fascinating shift in the power dynamic between labor and the corporate bosses. This may be coming to a head now as the UAW is asking for 36% wage increases, bringing back pensions. They want a 4-day work week. They want to know what the production schedules are at these companies. And I wonder what you think, what kind of effect this is going to have, because on the one hand, if they stay on strike, I would think that they're going to drive up the cost of cars even more, and they have barely recovered from the pandemic in those terms. On the other hand, they're going to boost wages for at least 150,000 workers and probably more who look over and say, I want that deal too.
Yeah, no. So on the one hand, at least the near-term issues, you're correct. I mean, we're counting on lower car prices and lower used car prices certainly to help on some of the inflation front. And if we cut off supply now, again, that's going to delay that. There's really large, I think, strong pent-up demand for automobiles already, and that's one reason auto sales, in fact, held relatively high despite rising interest rates. So that's clearly a near-term hit for the economy. The interesting thing, and I really like what you just said on the wages, is that to what extent does this become a signal for the rest of the economy, right? Is that if auto workers are getting huge raises, and we've seen huge raises in other industries, to what extent does that make other workers expecting a higher wage? So instead of expecting 3% a year, now they're expecting 5% a year, and then how does that work its way into inflation expectations? And you can tell a story where a series of negative shocks or those kinds of shocks really do, create a different inflation environment than we had in the pre-pandemic period.
All right, Tim, thanks so much for joining us. Really appreciate that. Tim Dewey, Chief U.S. Economist, SGH Macro Advisors, getting his thoughts there. A little bit of a different spin than what we heard from our good friend Gary Schilling.
Yeah, for sure. I mean, Gary is going to be very bearish. That's how he made his name, and it's always worked well for him. His career essentially kicked off with the great bond bull market, and then he made money for 30 years before he said, you know what, I think we're going to have a housing crisis. And John Paulson said, come over here and work with me on this. And then they made an absolute killing. Right. So, I just don't know if that's still the right call. There seems to be a lot more nuance these days.
Yes,
right?
There does. And but it's always great to check in with Gary. Right now, let's head down to Washington, D.C. We'll get world and national news with Nancy Lyons.
Thanks, Paul. President Biden, who calls himself the most pro-union president in history, has just arrived in Detroit. He's ready to walk the picket line today with striking members of the United Auto Workers Union. It's believed by many to be the first time a sitting president has joined an ongoing strike. As for those contract talks, Bloomberg's Craig Trudell says all eyes are on Ford, which was spared additional walkouts due to progress in negotiations.
What we've tended to see in the past is that once the union really sort of digs in with a particular company, they tend to focus on bargaining with that company and placing priority with sewing up a deal with one automaker, and then sort of leveraging that to pattern in agreement with the other two.
Again, Bloomberg Global Autos editor Craig Trudell. Senate Republican and Democratic negotiators are said to be nearing a deal on a short-term spending measure intended to keep the government open beyond this weekend. But Bloomberg's Anne-Marie Hordern says the big question is whether the House can pass it.
If the Senate is able to pass this through and they send it over to the House chamber, will Kevin McCarthy, the Speaker of the House, put it on the floor? Because if he does, this will likely be a centrist vote. Moderates from both parties will vote this through, but it is the hard right flank. Some members have threatened to oust him over putting a bill like that on the floor.
Again, Bloomberg's Anne-Marie Hordern reporting from Washington. Hunter Biden is suing Rudy Giuliani and his former attorney. The president's son claims Giuliani and attorney Robert Costello hacked, manipulated, and distributed personal data on an external hard drive associated with Hunter's laptop. The lawsuit calls it a total annihilation of Biden's privacy. The laptop has been at the center of Republican-led investigations into whether President Biden was involved in his son's foreign business dealings. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
All right, Nancy, thank you so much. We appreciate that. So President Biden just landed in Michigan, joining the straight